The war is the biggest immediate challenge we face, but there are others that we must also navigate in our rapidly changing world as we recover from the pandemic.
Hello and welcome to day 2 of the forum. Thanks a lot for you joining us here in Sintra and online. Yesterday, we looked at the implications of surging energy costs, the state of globalization, and how digitization is affecting how we work and spend. This morning, we want to delve into real estate markets, supply chains, and inflation expectations. After lunch, we'll have this year's all-star policy panel, concluding then by announcing the winner of this year's Young Economist Prize. The Eurozone entered the pandemic with real estate prices high. Today, they're even higher. As rates rise, will real estate prices pop? And what exactly is the relationship between the property market and monetary policy? Today's second session, meanwhile, looks at the supply chain bottlenecks that emerged during the pandemic and asks, where do their origins lie? And how have they impacted inflation in the euro area? I'd like to turn now to the chair of both sessions, ECB Vice President Luis de Guindos. Mr. de Guindos, the floor is yours.
Giovanni, good morning. Well, thank you very much, Claire. Good morning, everyone. Well, today we are going to talk first about real estate. Real assets, the most important asset in the portfolios of the European households. And in order to do that, we are going to have, our first speaker is going to be John Melbauer, Professor of Economics at Oxford University and a Senior Research Fellow of Nuffield College. You have him here since the inception, so you are becoming a tradition, John. So welcome again. So your paper is on real estate, the transmission to monetary policy, also with considerations with respect to financial stability and the implications for inflation. So in that respect, I think that this is quite relevant. And John's paper is going to be discussed by Giovanni Del Aricia, Deputy Director of the Research Department of the IMF, that you have worked extensively on credit booms and real estate booms in that respect. So, without any further ado,
make some brief comments about how commercial real estate differs from residential, and then conclude with a discussion of how monetary policy working through real estate has worked, the new macroprudential framework, leaning against the wind, and the risk outlook if there is time. So history matters. It matters not only to the analysts like us, but to the participants. And here I've selected the 5 largest Eurozone economies plus Ireland. Ireland is very interesting, of course. And you can see the tremendous difference in the boom and bust cycle that occurred after monetary unification in Europe and, of course, in the run-up to the global financial crisis. An immense difference. You can see that France is kind of in between. It had a similar appreciation to Spain, but not the collapse afterwards. And you can also see signs there of cycles in the 1980s. There was a certain boom and bust in some countries. Now, the big boom in the peripheral economies, of course, had much to do with monetary union and the fact that interest rates converged to very narrow gaps. Mortgage interest rates converged to very narrow gaps with monetary union, and that had a lot to do with setting off the boom in the peripheral economies, together, of course, with the financial liberalization, the unification, the cross-border financial activities that occurred. Now, there was a precursor to the global financial crisis in the UK and the three Scandinavian economies in the 1980s. And that's really rather interesting, and I wish we had learned more from that episode. You can see here that in Finland, in Sweden, Norway, and the UK, there was a big boom-bust cycle with quite serious financial crises in the three Scandinavian countries. And in the bank, in the UK, the Bank of England had to rescue the insurers of mortgages. The other interesting feature of this graph is go back to the early 1970s and look at the impact of the OPEC shock. So the oil price shock caused a fall in real house prices in Finland and the UK, both preceded by a big run-up. So there's a bit of a warning there. So let me talk about the role of real estate in the financial accelerator. This picture comes from our JEL survey paper with John Duca. And obviously in the run-up to the financial crisis, there were overly lax lending standards, so a shift in fragile fundamentals, leading to overvalued real estate, and then prices started falling. That feeds through to construction, to the demand for real estate, into consumption, which influences GDP, of course. And then on the financial sector in the economy, you had this big amplification mechanism in which property defaults and foreclosures affected the capital structure of the banking system, led to contagion panic, and therefore tighter credit standards for loans, higher risk spreads. And these tighter credit standards then feed back onto consumption, onto house prices, onto construction, into GDP, and so on. So it's a vicious circle in which the amplification was really quite enormous in the US. In Spain and Ireland, very similar things happened, except, of course, the financial system was far simpler. So let me talk a bit about the sources of heterogeneity. So thinking about the construction channel, the elasticity of supply matters quite a lot, and countries differ in the degree to which the building activity responds to house prices. The share of public sector housing differs. As far as consumption is concerned, one big difference is access to home equity loans and the rates of owner occupation. Another big difference is in the degree to which households extrapolate previous capital gains in housing. In countries where home buyers are heavily geared, the incentive, because of the capital gains and the reduction in user cost that comes from that, the incentive to speculate is much higher when you're heavily geared. So you pay much more attention to past appreciation. And that, of course, varies with the degree of mortgage interest tax relief and whether high loan-to-value ratios are available, and also whether property taxes are linked to current market values or not. So clearly, regulation, financial market structure matters a lot. Lax regulation, if that permits high levels of gearing, both for banks and mortgages, then you get much greater amplification. And having a fixed rate mortgage market slows the transmission of the policy mitigation that is available when the crisis breaks. So in the UK, for example, the ability of the Bank of England to bring down interest rates very rapidly really made a huge difference to the UK and the financial crisis. Maturity mismatch is another issue that matters a lot. Ireland being a particular case where maturity mismatch in funding mortgages mattered. Having countries where state or collective insurance schemes are widespread also makes a big difference to financial stability. On this slide, I mentioned some of the other differences which affect the transmission to the wider economy. And once again, financial regulation, financial structure, complexity, interconnectedness, and all these things matter a great deal. So to illustrate some of the differences between European countries, here is a picture of how the mortgage debt to income ratio for the 6 economies I'm concerned with differs at the moment and has evolved over time. You can see the Netherlands is the champion. The Netherlands, of course, has very big incentives for households to have mortgages because of tax relief. Italy is at the very bottom. You'd also see that relative to the kinds of fluctuations in the mortgage debt to income ratio that occurred in the run-up and post-financial crisis, the recent level of fluctuations is quite moderate. So that's encouraging. I mentioned the construction channel as an important element in the transmission to GDP. Well, here's a picture that shows how incredibly volatile residential investment can be as a share of GDP. And look at the Irish graph, the green graph. This incredible collapse from 10% or more of GDP to 2% of GDP. And similarly, in Spain, there was a very large fall in residential investment, also in Netherlands to a degree. This, of course, has very big implications for employment and the economy as a whole. So it was fairly evident from the picture of the financial, of how the accelerator feeds through to the economy that the housing channel is going to work in terms of policy from the transmission to the mortgage rate, from the transmission of policy to house prices, to residential investment, to consumer spending, to mortgage debt, and then potentially, eventually, to non-performing loans, because non-performing loans give you an indication of the fragility of the banking system. When non-performing loans rise, it's much more difficult for banks to extend credit. And in some countries, one can actually empirically estimate a 7th channel, which is the effect of house prices on income expectations. Absent in some of the European economies I've looked at. So I asked myself, well, how well do central bank models actually capture these 6 channels? And I'm afraid the answer is not very promising. In fact, there are only 3 of the 6 models I've looked at here that have reasonable linkages between the banking system and the real economy. So that's a major defect of many central bank models. They simply haven't tried to address the linkages between the financial system and the real economy. And, at a more sort of nitty-gritty level, to what extent do they include lending standards? Because lending standards are really important. Poor lending standards before the crisis actually helped to lead to the crisis, and the tightening of lending standards in the crisis fed back on the real economy. So including lending standards as a control in all these channels is critical. And very few models actually do that. Something else I should mention is that nominal interest rates actually matter quite a lot. And very few of the models include a role for nominal interest rates. None of the models actually try to model NPLs themselves. So, I think there's quite a contrast between the sophisticated understanding that's there in the financial stability sections of banks and the lack of such understanding that seems to be there in the modeling of the macro used for monetary policy setting. So for France, I was able to build on work that Valérie Chauvin and I did and do some further work to explore how, in the case of France, these 6 channels actually work. And we showed that in every one of the 6 channels, there is a significant, often highly significant, crucial, in fact, role for the control of lending standards. So the house prices, consumer expenditure, mortgage debt, it's critical that you control not just for interest rates, real and nominal, but also that you control for lending standards. So the approach that we use is the latent variable approach, where we pick up mortgage lending standards as the common factor in equations for house prices, mortgages, and consumption, after taking account of a full set of economic and demographic factors. This is a bit like the Sherlock Holmes approach. You have a crime, you have a list of suspects, you eliminate all the other suspects, and the one that remains is the guilty one, and the guilty one is lending standards. Just one other feature of this. Under 4, consumer expenditure. None of the central bank models actually control for the house price to income ratio, which is an important aspect of the story, because if there is a housing collateral effect or a housing wealth effect, there's also a negative effect that concerns the non-owners or the renters who have to save harder for a deposit when house prices become less affordable. And it's important to control for that. Moreover, it's important to disaggregate household assets into liquid and illiquid and debt. It turns out that debt is far more negative in its influence on consumption than the central bank models suggest. Here's what our latent variables look like for France. Financial liberalization in the 1980s, both for consumer credit and for mortgage credit. A bit of a collapse as NPLs rose in the mid-90s, and then the renewed liberalization in the 2000s, followed by a moderate contraction in France after the global financial crisis. So I was really thrilled to discover that our latent variable had remarkable properties in its ability to forecast future non-performing loans. We didn't know that in advance of doing this work, but it turns out the T ratios are like 15 or something like that. So we have a model for non-performing loans in which recent short interest rates, the unemployment rate, the house price to income ratio, income growth, and average of lending standards going back 1 to 5 years previously. So history matters. It isn't just what happened the last year that matters, but it's lax lending standards over a long period that matter. So what we would call a perfect storm would be years of lax lending conditions, followed by a rise in interest rates and unemployment, a fall in house prices, and a fall in income growth. That would be a perfect storm. Fortunately, at the moment, we haven't had years of lax lending conditions. Just to illustrate how close the relationship is between the NPL ratio and our estimated latent variable, this is what it looks like since 1990. So just to sort of summarize what the implications are for the credit cycle, what we found is there's a strong connection between lending standards and real estate prices, credit growth, consumer expenditure, residential investment, and also eventually of NPLs. So in the short run, looser lending standards promote growth, but in the long run, they have an impact potentially on NPLs that could be damaging. Interest rates themselves, of course, have a similar role in all these equations. I mean, every single variable, real estate prices, credit growth, consumer expenditure, and so on, is affected by interest rates as well. So it's really important that we understand the joint influence, both of monetary policy and of macroprudential policy and prudential regulation in how the credit cycle and the economic cycle operate. And as I say, that there's this contrast between the two wings at central banks, the monetary policy wing and the financial stability wing. So let me comment a bit on how our research on France potentially could improve the ESRB risk scoreboard. Now, that risk scoreboard captures what the ESRB calls collateral stretch, funding stretch, and household stretch. And there are 10 detailed indicators in there, which include things like the house price to income ratio and various other things. There's also information from the bank supervisors on loan to value, loan to income ratios, at least from one recent survey across the Eurozone. And the question is, well, how do you summarize all this complex information, some of it contradictory, to try to get at what the underlying lending standards are? Were they too lax, or were they justified by fundamentals? And the French evidence suggests that the latent variable approach is highly successful in extracting an indicator of mortgage lending standards, given its amazing performance in forecasting NPLs. So my proposal is that a stripped-down two-equation version of our more complex French model could be rolled out across the Eurozone with panel methods compensating for gaps in historical data. So I see the three benefits of the latent variable approach in this context: that you get a regularly updated latent variable estimate of mortgage lending standards, which would add a valuable new indicator to the scoreboard. You get an improved specification of the house price equation that would give a more accurate indication of potential overvaluation. And finally, as we all know, it's very hard to tell whether macroprudential policy is actually working because of endogeneity. The policy comes on when credit growth, house price growth is high, but that could be driven by fundamentals. We're not sure whether it's fundamentals or problems. So these endogeneity issues make it hard to measure the success of macroprudential policy. Well, the latent variable approach is designed to address that endogeneity, and so should make it easier to assess the impact of macroprudential policy on lending standards. Right, I said I'd make some remarks about commercial real estate. Thanks to the ECB, I've had access to a confidential database, a commercial database, and that shows some information on a comprehensive measure of the price of commercial real estate, again in real terms. You can see that Ireland had by far the biggest boom and bust. The German graph is much like the real house price graph. The other countries show a certain boom and bust, but more moderate than for house prices. So there are some differences between commercial real estate and residential, which the ESRB has discussed. The larger role for institutional investors, great exposure for international capital markets, that matters. But in practice, commercial real estate is quite correlated with residential. In fact, residential rental is part of what's called commercial. There are common shocks to credit condition, interest rates, and international investors have become very prominent in top cities, residential. There are some big data issues which the ESRB is onto. Defining even the concept of commercial real estate is difficult. And the data problems are a lot worse than for residential, more complex, opaque markets and comparability problems. So let me make some concluding remarks, first of all, about monetary policy and the housing channel. Now, monetary easing was intended to increase aggregate demand from households. But first of all, the impact has varied a great deal across countries. Much weaker in Germany than in other countries, in Spain or Ireland or Netherlands. The impact has also tended to be overstated, in my view. And that's partly because the negative longer-term impact has not been sufficiently taken account of. So lower interest rates obviously raise debt-to-income ratios, but higher debt levels have a remarkably negative effect on consumer spending. And then there's the negative affordability effect of higher house prices on non-owners and renters. Even without the credit cycle and the possibility of financial crisis that could follow from overvalued real estate. And then there's some seriously negative side effects on inequality between the old and the young, within younger cohorts, and so on. And then, as this prize-winning paper from Müller and Werner points out, credit-fueled real estate booms have tended to crowd out more productive investment with negative consequences for sustainable growth. So that's a very serious charge. So let me comment on the new macroprudential framework. I think the work done at the ESRB, the EBA, the ECB, country central banks, and the other regulators backed by the BIS and the IMF is really a remarkable progress in the last 12 years. I mean, it's really fantastic progress. Obviously, institutional heterogeneity is going to make it a functional necessity in the euro area for supranational bodies and the national regulators to coordinate and each make decisions and try to coordinate. Well, there's been a welcome push from the supranational bodies for much better data monitoring, for new instruments, very much approve of that, and minimum standards on the legal perimeter for the borrower-based macroprudential measures. So I think the system is actually working reasonably well. I think the macroprudential tightening that's happened in the last few years is now validated by the current economic crisis, which otherwise might not have been far from the perfect storm that I was talking about. So just my final slide is make some brief remarks about the leaning against the wind controversy. Since Lars Svensson is in the audience and you've all followed his debates with the BIS on this issue, you might be interested in some of my thoughts. Well, it seems to me that in the Eurozone, because of heterogeneity, it's even more difficult to follow a leaning against the wind policy. So we need to think about leaning against the wind more in an international macro context. And in my view, it's very unfortunate that fiscal policies post-crisis went more expansionary because the central banks had to step into the gap. And as a result, these high real estate valuations where the negative consequences are a byproduct. And I think more generally, failures by government to correct distortions in housing markets and to promote stabilizing measures like tax relief, stabilizing tax relief, making property taxes more linked to market values, those failures have made the job much harder. So finally, on the risk outlook, the two comments I'd make. One is that for investors, real estate looks like an inflation hedge. And that seems to me a worry when inflation expectations are rising in the way that they have been. And that suggests to me that controlling leverage on commercial real estate and buy-to-let residential is pretty important at the moment. I think that's an area where macroprudential policy needs to act. And then finally, I think on climate change, Europe is particularly exposed. European real estate is particularly exposed because such a high fraction of CO2 emissions in the euro area come from housing and other building-related activities. So holistic policy, the network for greening the financial system is doing fantastic work on this. So I very much encourage the ECB to follow that route. But we need holistic policy, cooperation between governments and central banks in this whole area. Thank you very much.
Thank you very much, John, for this polyhedric, comprehensive, and insightful presentation. Giovanni, it's your turn now. You have 15 minutes.
Okay. So let me start by thanking the ECB and the organizers for the invitation to my former boss for the invitation to be in this conference and discuss this very interesting paper. And let me, before I forget, say that these are my views and not necessarily those of the fund. They will deny any knowledge of my existence if you attribute the views to them. So let me start with something obvious. This is a great paper. I highly recommend everybody that wants to read a compendium of everything we know, and especially everything we do not know, of the relationship between real estate dynamics and monetary policy, to read the paper. It's long, but it's worth it. I mean, I was forced to. For you, it's more of a voluntary effort, but it's really worth it. And I think John did a fantastic job in putting together an enormous amount of information. So in this slide, I'm trying to summarize the many messages, and I hope I distill the most important ones. So first, the relationship is far from linear. There is a lot of complexity. There are a lot of local institution, culture, mores that matter in how interest rates transmit to and through real estate prices and mortgage markets. Second, I think our understanding is clearly improved since the global financial crisis, but we are far from where we need to be. And I think there are two aspects of this. One is the calibration of monetary policy models for so-called tranquil times, although I don't know, we haven't had many tranquil times recently, but for tranquil times and small shocks. And the other one, I think, is more of the elephant in the room, and is the prudential role that monetary policy may have to play in the context of boom and bust cycles. And I'll try to talk about that a little bit in this presentation. I cannot do justice in 15 minutes to everything that John did, so I'll focus on 3 of his 6 channels. And I think these are the 3 channels that are more important from the prudential standpoint, which I think is the more controversial part of the policy aspect of this. And I'm going to use several charts that come from work often co-authored with Luke Levin, who's in the room, and he'll be happy to take any questions if you have them. And you'll see that they are mainly meant to reinforce John's points. I agree with basically everything he said, which make discussing the paper a little bit hard, but luckily the organizer told me, you can go up there and say whatever you want, so here it goes. In summary, we know from experience that house price boom-bust cycles have often been associated with financial crisis, but there is plenty of evidence that the real problem is not house prices. The real problem is household debt and leverage that comes with that, and in particular, leverage in the financial intermediaries that fund the mortgage markets and a decline in lending standards that is often associated with these booms. There is also, and this is more recent evidence, a special role for the construction sector that John emphasized at some point in his presentation, so I'll talk a little bit about that too. So going back to the global financial crisis we are all familiar with, this is data from the United States at the state level. On the vertical axis, there is the increase in mortgage delinquencies at the start of the crisis, so between 2007 and 2009. And on the horizontal axis, there is a house price appreciation in the 6 years leading to the crisis. And the size of the Christmas balls is the change in mortgage debt during the same period. And you see there is an obvious positive relationship between both the increase in credit and the increase in house prices, with then the delinquencies in the states that were at the core of the subprime crisis, like Nevada, Arizona, California. Now, when you regress this more rigorously using econometrics, in many, many cases, house prices turn out not to be significant once you control for credit. So what really matters is that people get indebted. And if we were all buying our houses with equity, like we do, say, the stock market, the problem would be probably much smaller. I'm not saying the problem would go away, it's still a big chunk of the household's portfolio. But really what generates a crisis is when debtors cannot pay debt. And this is testament to that. Now, the second chart I want to show is also from work with Luke, and is a relationship between the monetary policy rate, this is the real federal fund rate, and lending standard. So on the left-hand side, I'm plotting that against the capital asset ratio of the banking system in the United States. And you see that when the federal fund rate is low, banks tend to be more levered. And on the right-hand side is an internal rating that banks use in the United States to evaluate the riskiness of loans. And you see the loans are more risky when the federal fund rate is low. So you have two aspects of risk-taking that increase when monetary policy is easy. One is leverage. You have to squint a little bit to see the correlation, but it's there. And more clearly, the riskiness of loans. And finally, you get into the special role of the construction sector. After all the work we did on credit booms, we were saying, well, not all credit booms end up badly. I think the average is about 2/3 of credit booms end up badly, meaning in a financial crisis. But there is a third that soft land, and John had the example of France, where we didn't have a crisis after the boom. And so we started digging into these episodes to see if we could tell in real time which ones would be good and which ones would be bad, or at least have some signal, some canary in the mine. And the construction sector turns out to be a fantastic canary in the mine. So this chart plots the differential performance of value added and employment by industry in bad versus good booms. And you see that in bad booms, the construction sector is really booming. And one economic explanation for this, it may be that if house prices go up, but nothing really happens, say New York City, where you can have massive appreciations, but there is nowhere to build. Then you don't have a diversion of resources from the rest of the economy. I mean, you have these balance sheet vulnerabilities accumulating, but from a real point of view, the rest of the industry probably chugs along. But when you are in a situation like, say, Arizona, where together with the real estate boom and mortgage boom, you also have a construction boom, then things are possibly worse. So going to the point that John made that local institutions matter, I just wanted to list a few of the important parts. Of course, the level of mortgage debt in the country and the leverage ratios that are allowed by the banking system are critically important in terms of vulnerability. But there are also more nitty-gritty elements of contractual details that typically as macro people we don't look at, like fixed versus variable rates, or portability of mortgages. This is something people really never focus on. In the United States, it's very hard to transfer your mortgage from one property to the other. So if you have a fixed rate and the Fed tightens, like it has happened now, nobody wants to sell their houses, because if you sell the house, you essentially have a capital loss on your mortgage, because now you have to pay a much higher rate. In countries like Canada, where you can transfer the mortgage from one property to the other, this doesn't happen. So these details are really critical in the way monetary policy interact with the market, and we often forget them. The way the banking system funds itself to finance mortgage is also critical. You remember the role of securitization during the GFC. And finally, structural elements like land scarcity and building regulation are critical. So let me now switch to where we are now. And for those of us like me that are paid to be paranoid, this picture is not reassuring. So this is median across about 40 countries. You see building permits ballooned after the end of lockdowns. Real estate prices went up very rapidly, vastly outpacing rent dynamics. So this looks a little bit like the picture with the Christmas balls. But there are some reassuring elements. So one is that, so the mortgage rate matter. So there was faster appreciations in countries with low interest rates than in countries with higher rates. And this relationship seemed to have strengthened over time. So monetary policy seems to have some bite, not enormous, but it's there. But more importantly, the aggregate picture hides enormous heterogeneity. So on the right-hand side here, for obvious reason, I didn't want to put numbers, but it's a color-coded table of heterogeneous effects of monetary policy on real estate markets based on the various characteristics that John listed. So there is the history dependence, meaning how much house prices had increased in the past 2 years. There is the level of household debt. There is the share of households that have a mortgage, and there is a share of mortgages that have variable rates. And you see that even within the Eurozone, at one extreme, you have the Netherlands with a lot of sensitivity to interest rate changes. At the other, you have Italy at the very bottom of this scale. One piece of good news, and I think this is consistent with what John showed, is that the twin booms in credit and house prices that we witnessed in the GFC are much less prevalent now. One chart here is the correlation between increase in real house prices and household debt growth at the country level, and you see it was much higher in 2007 than it is today. On the other charts, I'm showing household debt service, which at least in this monetary policy cycle is starting from much lower level, especially in the US. In the Eurozone, a little bit less, but it's still there. And more importantly, and this is data for the US, I couldn't collect that the same for Europe, unfortunately. This time, the boom in mortgages preceding the monetary tightening was primarily driven by the so-called good borrowers. So high-quality borrowers with high credit scores had the lion's share this time, while they were a very small share before the global financial crisis. And this is probably what is contributing to keeping delinquencies down, even if mortgage rates in the US have increased dramatically. But again, I'm paid to be paranoid, so I'm looking now what policy could or should do. And this is a chart from the paper that John mentioned we had at the fund about 5 years ago, to which Lars contributed, in which we examined the cost and benefits of leaning against the wind. And essentially, in order to get a net benefit from leaning, we had to calibrate the models with all the most favorable parameters so that leaning would be a good thing to do, which meant that we were saying never lean, but we were saying, well, maybe there are better instruments than monetary policy to control risk in the associated with mortgages and real estate prices. And that's essentially macroprudential policy. But I think at that time, we had very little data to see whether macro-pru work or not. Now we have much more. This is a chart from a working paper that some of our staff put together. And they look, I think, at about 6,000 coefficients on macroprudential policy out of several, a few hundred papers. And they look at the effects of macro-pru, both on household credit and real estate prices. To make the story short, about 50% of the coefficients have the right sign, and they are significant. This sounds not particularly reassuring. But you have to consider that there is an attenuation bias in these estimates because macroprudential policies typically tighten exactly when credit is growing fast and real estate prices are going fast. And so 50% is not that bad. And in studies that use microdata and can control for the endogeneity, the coefficients tend to be larger and more significant. So the rest of the evidence on macro-pru is a little bit more sobering. So first, there is evidence of leakages, and in particular, cross-border leakages. And if you go back a few years to the stories of the Balkans, where they would impose macro-pru in one country, and there would be Austrian banks lending across the border. And this calls essentially for more cross-border cooperation and international coordination among macroprudential agencies. I think there should never be an IMF presentation without this sentence. So it's there. And And there are also leakages over time. And this is very similar to what we know about capital flow measures or capital controls, if you wanted the non-politically correct way of saying. That over time, the market learns to go around these tools. And so it's a game of cat and mouse between the regulatory agency or the central bank and speculators. And finally, there is evidence that these tools are more effective when they are aligned with the monetary policy stance than when you try to have the cake and eat it too, where you are tichtening monetary policy and loosening macro-pru or vice versa, and the effects are less. So the joke I always say is that macroprudential policy is not a third leg of macro policy, it's 1/3 of a leg. But it does help. So let me leave you, the takeaways I think are pretty obvious. Let me leave you with one final chart. So I think this is an interesting question for future research. Is there a structural effect in real estate from the pandemic? So if you look at the right-hand side, these are color-coded real estate price changes in downtown New York and San Francisco. And these are cities that were booming enormously before the pandemic. And then when the rest of the country real estate prices were going up, these prices were crashing. And on the left-hand side, there is a chart from a paper by Gupta et al. And let me move it because we updated it. And here, basically, you regress house prices and house rents on the distance from the city center. And before the pandemic, the coefficient was very stable and clearly negative. So further away from the city, prices were lower, rents were lower. And then when the pandemic came, the coefficient started converging to 0 because people didn't have to commute. And with remote working, why do you want to live in downtown Manhattan when you can have a much bigger house in Long Island or something like that? Those of us that have property in downtown DC know very well the pain that this has caused. And the interesting thing is that at least for rents, the trend seems to have reverted and things are going back to pre-pandemic levels, even if the coefficient is not as large in absolute level. For prices, we haven't seen the reversion to the mean, maybe because prices are sluggish. But I think it's a big question because this is going to affect dramatically the interaction between monetary policy and real estate in the future. Because if this is going to stay, we are going to have a massive restructuring within the sector. And this goes to commercial real estate as well, where downtowns are empty and there are commercial buildings that will have to be reconverted. And I think it's a great question for future research, and I'll stop here. Thank you.
Well, thank you very much, Giovanni. Now the floor is open. I see a first hand raised. You have the floor. Helen, afterwards. Perhaps we can collect 2 or 3 questions before you respond. Go ahead, please.
Okay, just a very quick comment on leaning against the wind, not about my own work, but about very fine work that has been done at the ECB by Tore Cockerell and Christopher Koch. And actually, I think that started under the leadership of Victor Constancio. The first time I learned about this was in a speech that Victor gave. But anyhow, this work has now come out first as an ECB working paper, and just recently as a journal paper in the International Journal of Central Banking. And it's really taking the law discussion to the Eurozone and modifying, calibrating the numbers to the Euro area. And it's very well done. Also, it has actually made an impact on the ECB strategic monetary policy strategy review, and is widely cited in the paper about financial stability and monetary policy. It's really worth reading. And if there is a revision of this paper, I think John should actually include this special work on the ECB. Of course, you know the result. Costs of leaning are substantially higher than the benefits. That's very robust for a lot of different cases. Thank you.
Thank you very much, Helen. No other.
Thanks a lot. It was a very interesting paper, both from an academic point of view and also I'm a member of a French macroprudential authority, so thank you very much for the contribution. I have a question regarding your interpretation of your latent variables. I wonder, how did you investigate a little bit more the determinant or the correlates of your latent variable reflecting the tightness of credit conditions with monetary policy, with regulation, and maybe a little bit less obviously with the structure of incentives of the financial intermediaries and the competition across intermediaries. There are some interesting stylized facts regarding heterogeneity in risk-taking across banks during boom times, and in particular the fact that the leverage distribution becomes much more right skewed, so a lot more assets become concentrated in large balance sheets when the cost of funds goes down. So I wonder whether you have investigated this and whether you could say a little bit more about this, because it's a key variable.
Thank you, Ellen. There is another physical hand raised there.
Thank you. So I have a question for both Giovanni and John. Both of you sounded like you were supportive of macroprudential measures to address some of these risks. And I was hoping you could talk a little bit more about which ones. We now have a whole set to choose from. And I'll give you a little more specifics on that. For example, LTV ratios are some of the most popular ones implemented, but highly cyclical because they're based on values by definition. DTI ratios, DSTIs, less well used, less politically popular because they're seen as being unfair to people at the lower end of the income distribution, but probably less cyclical, so it could make more sense. If you're worried about the leakages that Giovanni mentioned, then should you not even just focus on housing narrowly and do something broader like CCYBs? Or if you talked about the risks of commercial real estate, are there any specific ones we should be using more in commercial real estate which don't seem to be used as widely? So that's just a start, but are there others I'm missing? Just hoping for people involved in this area, where should we be focusing in this broad category of macroprudential regulations?
Okay, thank you very much. I think that we do not have questions coming from online participants. But I will take advantage of my position as moderator, and I will ask you something. One of the recent effects of the fallout of the war is that construction materials are clearly on the rise. And even today I have seen that a German entrepreneurial organization has complained about shortages. Do you think that this might have any sort of impact? Do you think that this is going to fade away? So, John.
Thank you. Yes, let me start with the last point. Undoubtedly, shocks like this, supply shocks, do have an impact and will have an impact on construction volumes. And that is part of the risk story in terms of the impact on GDP. Let me turn to Hélène's excellent question about the underlying structure, the risk-taking, and so on. So what the latent variable does is it looks at the outcomes. It looks at the outcomes for aggregate house prices. I've actually also estimated a model that includes the Paris house price. So I can explain Paris as well as the rest of France. And there are some interesting differences because Paris is much more sensitive to both to lending standards, to interest rates, and also to international factors than France. But nevertheless, the latent variable is capturing a kind of overall effect on mortgage growth and on house prices of all the micro stuff that's going on underneath, which is very complex and very hard to try to understand. So the controls are really crucial here. So, I mentioned the fact that the nominal interest rate in France is very, very important. Now, that has a lot to do with the way in which the French regulators regulate mortgages or housing loans in general. Namely, the debt service ratio is crucial in France. It's been recently, the recommendation is to reduce it to 33%, which I think is an excellent idea. The point is that when interest rates fall to very low levels, the debt service ratio drops, and then the banks extend a lot more credit if that's all they're looking at. And I think that has a lot to do with the rise in French house prices. In fact, from our model, a fall in the nominal interest rate from 3% to 2% causes a 17% long-run appreciation of house prices just by itself, without taking into effect all the other interest rate effects, namely the user cost effect and so on. So that's part of the story, and controlling for that is very important to correctly identify what the underlying trends in lending standards are. Now, Kristin asks a classic questions about the instruments, in particular the borrower-based instruments like debt-income ratios, loan-to-value, DSTIs. Well, what I just mentioned on France, I think helps to illustrate that point. I think in some ways it was a mistake for the French to concentrate so much on the debt service ratio, because it encouraged extension of credit when interest rates were low. I think it would have been better if they had used multiple, a broader spectrum of measures for regulation. I mean, generally speaking, debt service ratios, debt LTVs, there are all kinds of measurement problems. Different valuation standards in different countries. The data are very absent in many cases, because not only do you need to know what kind of lending standards were banks using before a measure was introduced in order to see what the impact is, and often the data on that are missing. So it's quite hard to measure these things well. But generally speaking, as my discussant pointed out, the evidence from the international data are that they do work subject to the endogeneity biases. But in my view, a combination of measures helps to reduce the leakages, and the ESRB actually pays a lot of attention to the non-banking sector in its assessment of the risks. So that's really important.
Giovanni?
Yeah, so I'm not going to speak about France. Know nothing about that. On the macro proof, I think, if you look at the evidence, there is, as John said, there is a lot of country specificity. There is evidence that what the so-called borrower side measures, like LTV, DTIs, have a direct impact, while when you operate on intermediaries, they can readjust their balance sheet. So you can increase a risk weight on mortgages, but that's unclear that it's going to stop the boom. Now, that said, I think that the political economy aspect that you mentioned is critical. I remember Stan Fisher many years ago, when he was governor in Israel, was complaining that they introduced macro-proof, and they were killed in the press by saying, oh, you are hitting the young couples trying to start a family. Because what an LTV is, student LTV is cyclical, but you need to have the money down. And typically you're going to hit the poor and the young. And on top of that, as for any other prudential measure, then when the crisis doesn't happen, maybe it doesn't happen because you impose the measure, and then you get killed in the press again because they say, oh, see, you were paranoid. There was no reason to do this. So I think that there is a very difficult political economy argument. For whatever reason, the public doesn't focus as much on interest rates the same way. When you raise the interest rate, you also hit the poor and the young, but it's not as direct. And I think it's a little bit easier for people to accept because it's more uniform. The final point I wanted to make is, I think we have a lot to learn from what we know of cross-border capital flow measures. Really, I tease my financial sector colleagues at the fund. They get very irritated when I call macroprudential policy domestic capital controls. But really, they are domestic capital controls. You are trying to put a wedge in an arbitrage conditions. So in a uniform interest rate environment, you are saying, this particular type of investment, I want to make it more expensive. And the market is going to see a profitable opportunity there, and it's going to try to go around. And so the answer is probably you had to use them. You have multiple countries and multiple legal systems is even more important because, you start a company in Luxembourg that has the only purpose of owning your house. And good luck trying to regulate that. And that would be obviously a way to go around. And I'm not a lawyer, so I come up with that in 5 seconds. I'm sure they can do better. So.
Thank you very much, Giovanni. Only one thing. I think that is much more politically palatable to impose capital-based macroprudential measures than borrower-based.
Yeah.
Okay, thank you very much to both of you. Now I think that we can bring this session to an end and go to the second paper. Thank you very much, John and Giovanni. So let me call our next speakers, Sebnem and Gabriel. So good morning to both of you. It's a pleasure to have you here. Our next speaker is going to be Sebnem Kalemi Ozkan. We are becoming as well, as a sort of tradition here in Sintra. He's professor of economics and finance at the University of Maryland. I'm not going to refer to the multiple positions that you hold now. And you are going to you have produced a very interesting paper for us about the studies, the studies on the effects of the pandemic on the euro area inflation in comparison with the US. That I think that is a very important topic now. And afterwards, Gabriel, you will be discussing the paper of Sebnem. You are director of the Austrian Institute of Economic Research in Vienna and professor at the Vienna University of Economics and Business. Gabriel is also a member of the Scientific Advisory Board of the German Federal Ministry of Economic Affairs and Energy. So you have the floor.
Thank you very much. Thank you very much. It's a pleasure to be here and to present to a distinguished audience. Our paper on global supply chain pressures, trade and inflation quantifies several issues raised by Madame Lagarde during her introductory speech. It is joint work with Julian Di Giovanni, who is here, also with Alvaro Silva and Mohamed Yildirim, who are joining us online. During the past 2 years, the world has been living in a pandemic cycle characterized by a series of negative sectoral supply shocks, relative demand shocks, that policymakers responded quickly and aggressively, stimulating aggregate demand unevenly across countries, which ended us witnessing large swings in economic activity characterized by collapse and rebound in domestic demand, GDP, international trade, substitution of consumption from services to goods, back to services, uneven labor shortages, and so forth. All of this played on a global scale, leading to supply chain bottlenecks and inflation. So what should monetary policy be doing in such an environment, and how effective it can be are questions that we are all searching answers for. And our paper is going to argue that a first step in answering this question is about quantifying relative importance of supply and demand underlying that inflation. So our paper takes a first step at this issue. We are going to ask 3 questions. First, how important were sectoral supply shocks in driving inflation across countries? They are going to be extremely important, and their effect is going to vary across regions. Supply shocks are going to account for half of the observed euro area inflation between 2019 Q4 and 2021 Q4, and they are going to account for a third of the observed US inflation during the same period. Our second question is going to be how important were foreign shocks and global bottlenecks in driving inflation in the euro area, given the larger openness of euro area to trade relative to the United States. Of course, they are going to be very important, Foreign shocks are going to account 2/3 of the observed euro area inflation during this period. And finally, we are going to revisit this complex phenomena of very strong recovery in trade coexisting with persistent supply chain bottlenecks. We are going to show you that compositional shifts in consumption playing out on a global scale is going to be very important for this. Trade actually didn't respond to the GDP changes during the recovery from COVID as strongly as it did during the previous episode of great trade collapse and recovery of 2008 and 2009. So our results are going to show you dynamic consistent with a short-lived trade collapse, strong recovery, and a long-lived persistent global and domestic supply chain bottlenecks. Let me start by showing you some stylized fact before going details of our setup that will show you clearly the pandemic-related labor dislocations is bound to show up as inflation when combined with aggregate demand stimulus. Starting with inflation and employment. This is a very important figure. I'm going to show you euro area on the left, United States on the right. And although employment recovered with GDP during the recovery, you can see that purple line, employment, was still below the pre-pandemic level as of 2020 Q4, when the pink line, which is headline inflation, started increasing, both sides of the Atlantic. This figure is about the global supply chain pressures. This is an index plotted in black here on both figures, constructed by my colleague, Julian Di Giovanni, with his colleagues at New York Federal Reserve. This index brings together several measures of supply chain pressures, such as shipping costs, delivery delays, and freight rates, and then purge demand from these indicators using new orders to understand the supply chain pressures. We plot that together again with headline inflation in pink, euro area on the left, United States on the right. You see that they increased together, starting their ascent early 2021. This early increase and collapse in the supply chain pressure index is about early Chinese lockdown, beginning of 2020, and then the reopening. Now, this dynamics is going to be very important because, as you will recall, during this period when supply chain pressure is increasing, inflation is increasing, trade also increased. This is going to make it very clear that looking at trade as a metric to decide the persistence of supply chain pressure is going to be a misleading thing to do. Trade, of course, collapsed and then rebounded. What I'm going to do on this slide show you the amazing country heterogeneity in this narrative. On the top, I'm plotting euro area imports and United States imports, real imports, from the drop from the 2019 peak and recovery in pink. This is the COVID episode. Compare that to global financial crisis in the purple. You can see that the heterogeneity in imports clear. There was a steeper drop in imports in euro area, less so in United States. This goes back to this compositional shift started early on in the pandemic, stronger in US, where consumer demand switched to goods and stayed strong and met by the imports from China. In the bottom, I'm plotting Germany exports specifically and the United States exports, real exports again. Again, the pink is COVID episode, purple is the great trade collapse of 2008. The recovery was quicker, but never back to fully normal, to the horizontal black line, indicating of limited production capacity and supply chain destructions. Consumption, compositional changes in consumption is going to, of course, match these trade patterns, and inflation is going to match these patterns too. Here's consumption. On the top, again, euro area and United States real consumption, the steep drop during COVID in pink, and nothing going on in global financial crisis. Now, what is important is the compositional change driving this consumption drop. The bottom, euro area, and then United States decomposition. You can see the purple is showing you durables, pink non-durables, and orange services. When durables start to recovering very early in United States and then the Europe, services were lagging. And as you see, we do everything till the end of 2021, and it didn't recover at all back to the 2019 levels. This is going to be reflected in inflation patterns, as you see in this slide. I am plotting headline inflation and core inflation for euro area in pink, United States in purple, and UK in orange on the top figures. Again, inflation started picking up in 2020, steeper and a little bit earlier for the United States. But what is important to understand what really happened is the bottom figures. Services inflation on the left, goods inflation on the right. You see that at the end of 2021, services inflation at mere 3%, whereas good inflation, both in euro area and UK, up to 8%, in United States, up to 10% at the end of 2021. Let me show you a simple schematic that summarizes this database narrative that will show you how global scale supply and demand imbalances work out. Let us all remember the primitive shock here is a global health shock. When COVID started, negative supply shock due to workers contracting disease, taking care of people with COVID, lockdowns started the supply chain disruptions. Demand switched from services to goods because of fear of going to restaurants, limited mobility, and uncertainty. Then aggregate demand stimulus came. That intensified this compositional shift from services to goods, made supply chain disruptions much worse because those disruptions by essence talks about a disequilibrium, imbalance between supply and demand, and ended up with inflation. So how do you quantify this? We would like to quantify this in a closed economy and an open economy. In a standard model, these type of sector-level shocks are transitory, and a sector's demand is high relative to another sector, a sector productivity low relative to another sector. These are no issues for monetary policy. Relative prices is going to adjust, and there is no need a response from monetary authority. In a world where such factor mobility is limited, factors are complements in production, and some of your factors are imported, a country can have inflation because of both domestic shortages and global shortages. We are going to use the macro network model, closed economy model of Bakai and Farhi, recently published in American Economic Review. This is a multi-sector two-period model. It allows all the realistic complementarities in production, a full-fledged inclusion of the full intersectoral I/O linkages depicted in this figure. This shows you the linkages for 45 industries so you can see. The color coding in this figure tells you the tradable industries such as electronics in red, non-tradable industries such as wholesale and retail or construction in pinkish color. You see that it really doesn't matter if you're tradable or not tradable. We all saw this during the pandemic when construction sector had to stop production because they couldn't get the parts, even it is a non-tradable sector. There are a lot of non-tradable services sector that is going to be sourcing from other sectors domestically and internationally. Now, take this figure and embed this in a production structure in a standard, well, not standard, a little bit complicated, but a macro network model where there are layers of production. Consumers consume a variety of goods, cars, groceries, services, other durables and all. Those varieties are produced with intermediate goods and capital and labor that are sector-specific. Intermediate goods use other sector-specific bundle. A car needs plastic, steel, glass, labor, and so forth. Normally, we stick each layer of production with these elasticities in economic models, thetas, epsilons in this figure. We learned early on that applying a Cobb-Douglas production function in the short run wouldn't be the right thing to do because that production function assumes substitution and will not be able to capture the realistic difficulty in terms of substituting among inputs and suppliers, which we live through. So what we are going to do in our calibration exercise to decompose euro area and US inflation, use realistic short-run elasticities estimated in the literature. We are going to focus on this period, 2019 Q4, 2020 Q4. Why? Because we would like to capture both collapse and recovery. We would like to decompose observed inflation, and we would like to stay away from the developments in 2022 with the energy and the war issue. The Bakai-Farhi model is going to allow us to observe inflation under a rich set of shocks. Aggregate demand, we are going to pull it out from by matching to observe inflation. Sectoral demand and sectoral supply shocks, for those we are going to use data on sectoral consumption and sectoral labor hours worked. The model is also going to allow us to decompose inflation into parts coming from the supply side and demand side at a sectoral level. So the key intuition can be summarized here. CPI inflation can be mapped to two objects in a full-fledged general equilibrium model. Aggregate demand shocks in a closed economy, think this as nominal GDP expenditures, and a minus entry of employment changes. Now, these observed employment changes in the data is going to come both from sectoral demand and sectoral supply shifts. But it doesn't matter because it enters with a negative sign. When these quantities goes down, when we have low labor shortages, that's going to be inflationary. That's the key insight in this model. Employment behavior is going to be very important because we think it by sector instead of an aggregate labor market as we always do with our one-sector models. There's a potential level of employment, L bar, and that can go down because of workers getting sick and lockdowns. Then there's an equilibrium employment level, L, and that can change because of demand effects and downward nominal wage rigidities. If wage cannot fall, then there has to be unemployment. This simple figure demonstrates this. Very simple two-period model. You start with equilibrium pre-COVID, labor equals potential labor. During pandemic, potential labor goes down. Equilibrium labor also goes down. That's what has been called Keynesian unemployment by these co-authors. Once aggregate demand stimulus comes back with the policy response, of course, that red line you see there is going to go back up. And after the pandemic, you go back to normal. Let me show you our result using this setup. We are going to decompose observed headline inflation in the euro area of 4.69. You can see both the figure on the left using the full network of 45 sectors of the euro area and the figure on the right, which aggregates them to 3 sectors, tells you the same story. Half of the observed euro area inflation is driven by sectoral supply shocks in the purple column. The orange column tells you inflation would have been around 3% without the extra 2+% added through the sectoral supply shocks in euro area. United States, we work with a higher observed headline inflation of 8.47. The qualitative result is the same. Sectoral supply shocks is going to be very important, but their importance is less than the euro area. 1/3 of the observed US inflation is explained by the sectoral supply shocks. You can see in the red column, inflation would have been around 6% in the United States without the 3% coming from the supply side shown in the purple column. Of course, these are open economies and the networks are global. So here I show you that pink figure again, linking sectors in an economy. These are structural I/O linkages. I want you to envision that pink figure inside the blue figure. Blue figure is the trade linkages between the countries. The color coding is such that open countries like Ireland is going to be very dark blue. Less open countries like US is going to be light blue. Size of the boxes is going to be the size of the countries, and the thickness of these arrows is going to give you the intensity of trade relationship between the countries. Of course, once you embed that sectoral linkages into these trade linkages, you have this very complex global trade and production network. We are going to use this data to understand the role of global bottlenecks on euro area inflation. You can see euro area countries are going to have a very, very important place in this network. How do we do this? We are going to follow the model in my earlier work that makes the economic case for global vaccinations, which extends Bakai-Fahri closed economy model to a multi-country setup. To give the message very clearly, here for euro area inflation, we are going to focus a 3-country setup. Euro area, United States, and everything else, all the other countries, all the 65 countries you saw on that figure, summed together in the rest of the world category. Then we will work with 3 scenarios. All of these 3 countries get all the shocks: aggregate demand, sectoral supply, sectoral demand. Shocks are only in the euro area, and shocks are only in the United States and the rest of the world. And here is the result that shows the importance of global bottlenecks on euro area inflation. They explain 2/3 of the observed euro area inflation. You can see in the red column that euro area inflation would have been 2% at the end of 2021 without the 3.26% that comes from the outside shocks. That yellow column assumes shocks are only in the United States and the rest of the world, nothing going on in the euro area. Let me close with the last point and then with the policy implications. Given the importance of these foreign shocks for euro area inflation, can we explain the simultaneous occurrence of strong recovery in trade and persistent supply chain bottlenecks? In fact, this observation in the data led to erroneous thinking that supply chain issues is going to clear very quickly, will be transitory. We are going to use an accounting framework that was used before by Bams Johnson and Yee to explain the great trade collapse and recovery during 2008 and 2009. This framework is going to give you expected international trade flows by looking at the changes in final demand. That is going to initiate changes in imports and exports, also changes in the intermediate demand that's used in the production of that good that you are changing your final demand for, as shown in this equation. That will allow us to calculate export and import elasticities relative to GDP changes, both during the collapse period of COVID, 2019-2020 year-on-year from second quarter, and recovery period 2020-2021. We do the same exercise for global financial crisis, for collapse 2008-2009, and recovery 2009-2010. Very interesting pattern here. The top is great financial crisis associated with great trade collapse. The bottom is COVID pandemic. What you see in blue there, this is data. The left side of the table is data, right side is the model. The data tells you, as you can see, the bottom numbers are much smaller than the top numbers. What does it mean? It means that trade responded much less to the GDP changes during COVID when you compare to the previous episode of great financial crisis. And the model numbers on the right in red tells you the same story. Model numbers are smaller than the data numbers, of course, because the model cannot capture the whole reality. But the fact that this very simple model tells you there is less response of trade to GDP changes during COVID relative to great financial crisis. And we also showed that intermediate goods trade played a bigger role during COVID. This is, of course, maybe not that surprising as they are very different shocks. One is a global health shock played out unevenly by country sector. The other one is a financial crisis. Let me finish with the policy implications and what this all mean for central bankers. We are writing the paper for central bankers at the end of the day. Aggregate demand stimulus in a supply-constrained world has larger inflationary effects. We demonstrated this clearly in the paper. But central banks operate in an aggregate demand world. A Phillips curve-based one-sector model is going to have a very hard time in trying to separate a series of sectoral supply shocks that can have permanent effects from a one-time permanent aggregate supply shock that will go to Y star to potential output in the Phillips curve. We argue that central banks can make use of these that will give you a way to deal with asymmetric sectoral supply, relative sectoral demand, and aggregate demand shocks. Nominal wage rigidity in these macro network models combined with these supply shocks leads to labor rationing. Then you have your cost push shock starting in few sectors, but then becoming broad-based inflation. The theoretical underpinning of this story is done by Lao Tapassalai, Bakai Fahri, Gurari et al. Papers. And in fact, Emmanuel Fahri was a very good friend of mine, and this was the last topic of conversation we had before he passed away in 2020. We were talking about how exciting it would be to apply their theoretical framework to quantitative approach and use it for policy making. This is what we do in this paper, and we are really proud of doing it, quantifying this for euro area and US inflation. To conclude, aggregate demand stimulus would not have produced as high an inflation as the one we observe without the negative sectoral supply shocks. I would like to remind you our numbers. Half of the observed euro area inflation, 1/3 of the observed US inflation driven by sectoral supply shocks. Limited factor mobility and complementarities in production, these are byproducts of the pandemic. This was a global health shock, worked out unevenly by letting firms having difficult times in relocating labor between sectors, finding or new suppliers, switching suppliers domestically or internationally, leading to global supply chain bottlenecks and rising prices. The early belief that the strong recovery in trade is going to mean we are going to get rid of these supply chain problems very quickly turned out to be misleading. Much lower trade elasticities, we estimated for the COVID period compared to 2008 crisis, and that shows the importance of persistence of global supply chain bottlenecks. Euro area is more open to trade than the United States, which means that foreign shocks did play a bigger role in explaining the euro area inflation, 2/3, between 2019 Q4, 2021 Q4. None of this means that central banks shouldn't react to inflation. In our model, as any other model of monetary policy can tame inflation in a given country by contracting aggregate demand. However, there will remain upward pressure on price growth as long as global supply chain bottlenecks persist, as Ms. Lagarde pointed out in her introductory speech. Thank you very much.
Thank you very much, Sebnem. Thank you very much. Very rich and informative presentation, and thank you very much for the policy implications. Gabriel, you have 15 minutes.
Thank you very much. Let me first say how great it is to be here in Sintra at this very distinguished conference. And I'm grateful to discuss this paper. Sebnem, you did a brilliant job. It's very clear and I think important piece of work that will inform policy making, not just monetary policy making, but broader trade policy, for example, as well. I would like to do three things here. First, of course, provide a short recap of what I will call the DKSY paper, some comments, and then give you a few stylized facts, some more facts, as Sebnem has already shown quite a few, and then very shamelessly use the occasion and advertise some work of my own that has relation to what we're seeing here, namely, okay, we have these foreign shocks affecting the Eurozone and other countries. What can be done? Is decoupling a way to insulate our economies from these supply chain problems? I think the key equation in the framework that we have just seen is in the first bullet point here in my list, that maps wage changes in sectors into the change in the consumer price index. And that mapping is done through the complex interrelationship of sectors, through the input-output linkages. And that means that different sectors, be it services, durables, whatever, the wage changes that affect there are put together into an aggregate wage effect through the input-output connections. And what the authors then do is they use observed labor supply changes. That's the shocks that the pandemic have brought about with very different effects at the sectoral level. Again, use the input-output relationship between those sectors to come up with something like an aggregate supply shock. That's this lambda prime D log L. And they take the observed price change, the consumer price change in the economies, and use that in the equation that you displayed here to back up the aggregate demand shock. And that's the decomposition that is then, put very simply, used to produce the graphs that we have seen through the lens of a much more complicated model, the decomposition into supply chain or the supply bottlenecks or supply shocks and aggregate demand shocks. I think this is very useful and a very plausible way to come up to the result that Sebnem has insisted on, namely that supply shocks explain something like half of Corona time inflation in the Eurozone and about 30% in the United States. And the missing part, of course, is then the role of aggregate demand shocks, much bigger in the United States than in Europe. Of course, this is a stylized model, and that's a virtue, of course, because it makes it easy to comprehend and easy to communicate. But of course, there are concerns that I find in my own work as well. One is that when we work with input-output data, that's the information that we have on the global scale and we need here, then the data is still very coarse. It's much better than aggregate data, of course. But within sectors, take the chemical industry, we have, of course, supply chain relationships as well. So there's a vertical structure in the chemical industry, there's a horizontal structure in the chemical industry, and within that industry, we can have very different supply shocks too, that through the input-output linkages are are going through a multiplier effect and coming out bigger through that structure than if we lump everything together within a sector. The other thing that I thought a little bit interesting reading the paper is that what is very important on my agenda, namely trade costs and what happened to trade policy, what happened to shipment costs, transportation costs, it doesn't receive much attention in that in your paper, and so we at least I have worries that we see a rise in protectionism. We've seen part of it in the Corona crisis. We have seen a rise in export restrictions that we have not seen for a very long time in history. We see more of it now as we suffer through that energy and food price crisis, and the role of the cost changes or policy changes at the links between countries and sectors. I think that is something that merits more attention. The other thing that is discussed in the public quite a bit now and is not emphasized in the paper we have seen is the role of imperfect competition. That when you have supply shocks occurring in the sector, then what we should also expect is that firms exit. There's a smaller number of firms, less competition meaning higher prices, leading to even more of a supply shock impact. So putting all that together, I think what we have seen is actually conservative estimates. So supply chain restrictions, or supply side restrictions could even possibly explain more in a model that goes away from sectors into more granular data and also has endogenous markups. There's a lot more in the paper, and I think Sebnem did a brilliant job in explaining it. We have this shift towards tradables that that was not expected, and that led to a lot of supply chain issues. We have the fact that effective trade elasticities are reduced to supply chain bottlenecks. That means that the response to supply side shocks are bigger. We have that nominal wage rigidities that are very important in that model. Can lead to the fact that single sector negative supply shocks can create countrywide inflation. That's the paper has a very nice short explanation for that. That's easy to read for everyone. And then we have that fourth result, that foreign shocks and global supply chain bottlenecks really mattered a lot, in particular in the Eurozone in that Corona period, more than in the United States. I think this is all plausible, even if the model framework is, of course, stylized, and it has a very clear monetary policy conclusion that Madame Lagarde has emphasized and Sebnem has told. I think that's something we can now carry out, at least from Sintra, and say that we have a lot of evidence pointing to that conclusion. And indeed, it is something Sebnem pointed out quite nicely too. It is misleading to only look at goods trade and from that think that bottlenecks don't matter, no, or have not mattered in the crisis. What you see here is global trade, goods trade that is. You see in red the Corona crisis. You see the V-shaped recovery of trade flows. You see that in the last data we're already 8% above the pre-crisis level. So trade is actually doing well, and one could, of course, conclude from that, what are you talking about? Bottlenecks in supply chains are not showing up in the data. And in particular, the difference to the Lehman crisis, the GFC crisis, is quite stark. Then this is the blue line situation was much slower, recovery was much slower. But I think that's an important lesson from the paper. That would be a premature conclusion. We need to compare to the right counterfactual, and without the supply chain disruptions, actually trade, the global trade flows, the red line, would have expanded even more. And that's relevant from a macroeconomic point of view because demand has shifted, and it is that increased demand for durable goods that was not fully satisfied by that in delivery times. The latest data that's available shows that delivery times go down a little bit, at least if we look at the big trade routes from China westwards or eastbound or westbound. I have some own statistics that I like a lot. If you look at the container ship industry worldwide, we can observe container ships every 15 minutes, actually see where they are, see whether they move or not. And the interesting fact is a lot of container ships are not moving. And I'm not talking about them sitting in harbors. They're not moving. No, that's container ships sitting at the Georgia, South Carolina coast. These container ships idle around South California, Los Angeles, Long Beach. Then you have the North Sea. Look at the latest data. That's from the 21st of June, so quite recent. North Sea traffic jam building up, and then of course we add China, and we get a lot of action from there. And the disturbing feature of this data is that in the last months, in the last weeks, I must say, the traffic jams have again built up, and it's not just China; it's also North Sea, and that means we're probably not seeing. That ocean delivery times movement that we have in the last weeks of that slide being continued, unfortunately. So that's another source of stress potentially for global supply chains. Now, the global supply chain pressure index that we have already seen, I think, is a fantastic tool, and maybe that's more for curiosity. But if you compare again that index in the Corona time, that's the red line, and in the Lehman episode, you see that in the Lehman episode, exactly the opposite happened, at least in the first months of the shock. Global supply chain pressure actually went down after the GFC set in. We had exactly the opposite, and that shows that it was probably erroneous to compare the Corona crisis to the Lehman crisis, as some, at least in the first months or so of the crisis, did. The supply chain picture was very different. But let me look at a little bit more longer horizon. We have talked about 2 months in the paper we have seen, and I've talked about the last weeks or months. But what I find worrying is that something happened in the global economy that actually predates very much the Corona crisis and even predates a little bit the onset of the GFC, namely the end of a long-running trend where global trade expanded faster than industrial production. And that is something that is still unexplained. Now, of course, we are looking here only at goods market globalization. Services play a large role. We have difficulties measuring them properly. But there is building evidence that a rise in protectionism explains this phenomenon that the economists have called the phenomenon of globalization. And that is worrying because that could mean that the pressure that globalization put on goods prices is no longer there, and that a rise in protectionism adds to supply chain stress, reduces competition, reduces the capacity of the global system to respond to shocks. And I think the picture that is there since 2007 or so, despite the ups and downs, despite the interruptions of the crisis, is a worrying one. We should care about that. And that's maybe also something where central banks should raise their voices and ask for restraint in trade policy concerns. And then let me wrap up with some shameless advertising, as I said at the beginning, and discuss very briefly a paper that's fresh by some co-authors of mine, where we try to understand whether global supply shocks, the stuff that's discussed in Septem's paper, affect our economies differently when they decouple their global value chains or not. So the question is, how much would a potential decoupling insulate the EC, the Eurozone, or the US, or other countries from the negative supply shocks in foreign economies? And that's a model that's very similar to DKSY. We have also this global input-output relationship. There is some break to sectoral labor relocation. We have different sets of trade elasticities. We can distinguish between the long run and the short run, and so on. And we calibrate the model to the China lockdown shock in winter spring 2020. So and we can talk about inflation with some wriggling, because welfare is essentially the inverse of the price index. So if the price index increases, we say inflation, welfare in this model goes down. And there's an important message that I want to convey here, namely decoupling would be very expensive. Now I'm showing you here the most drastic picture that I can show. Now that would be decoupling of global value chains, even within the Eurozone. No, we're certainly not expecting that, but that's just to show what the numbers would be. We're talking about welfare losses or price increases, that is, in countries like Ireland, Luxembourg, the Baltics, of about 50, 60, even close to 70%. So this would be dramatic. Of course, in the paper, we save the Eurozone and so on, so we can do a lot of different experiments, and that would, of course, bring down the costs, but it remains very, very expensive. And then, if we stack the cards against us, that's what referees have pushed us to do, and ask what's the insulation effect of not being linked into global value chains, and I'm not stopping here final goods trade, it's just intermediate goods trade, then foreign shocks would affect us less. No, that's obvious, that's not a big surprise, but the numbers in play are very telling. The costs of decoupling are an order of magnitude bigger than what the short-run benefits of insulation would be. So that's a warning against those who hope by decoupling we would make ourselves less vulnerable from foreign supply side volatility. Let me stop here, and thanks again for the opportunity to discuss the great paper.
Well, thank you very much, Gabriel. I think that both of you have paved the ground for the Q&A that we're going to have now. And afterwards, Ricardo. We have 3 questions. Let's collect 3 questions, and afterwards we will continue.
Excellent paper. So you emphasize supply shocks. I guess the other side of the coin is the demand effects, which in the US I take to be very large. There's a large debate about the relative roles of perhaps excessive fiscal stimulus versus perhaps too stimulative monetary policy. Your model is very nice in that it speaks to sectoral effects, and monetary and fiscal policy have very different sectoral effects, with monetary policy, of course, working more through interest-sensitive sectors. Can you use your model to speak to that debate and sort of parse out how much the aggregate demand shock comes from different effects? The other question I wanted to ask is about interaction effects. So the effect of a given amount of demand on inflation is presumably going to be different depending on the state of supply. And so I wondered whether you could speak to these interaction effects, and notably whether, for example, the monetary multiplier currently is different than it might have been historically, given the state of the supply, with effectively the supply curve having, hopefully, a more favorable slope now than it had historically.
Thank you. Ricardo?
So, sorry, 2 nerdy measurement questions on your 2 exercises. On the first, when you take out from GDP to measure aggregate demand, the formula that comes out of the model is really to use changes in sectoral hours, and therefore different results between the euro area and the US are driven by differences there. But the way you build those hours has to do with using, especially for the US, sectoral employment changes. Now, the US and the euro area had very different employment policies in terms of whether you had furloughs versus falls in employment or not. So could this not be biasing your results towards finding a much smaller effect in the US, simply because there you had a lot of adjustment in employment they did in the euro area, and so you're going to say, aha, therefore this goes into higher inflation in the euro area. On the second measurement exercise, somewhat related, again, the measurement is really very much based on these changes in employment for the sectoral shocks relative to a potential. That's the Keynesian employment that you very well illustrated. But of course, I think that you assume, and clarify if not, that any change in employment is this Keynesian because the potential hasn't changed. But again, we know, or we suspect, actually we don't know, that there may have been very permanent changes in sectoral composition as a result of COVID. Insofar as those permanent compositions are there, you will again be overstating the sectoral contribution that you find to the Keynesian mechanism because you will be confusing the extent to which we're just shifting from some sectors to others permanently, and you'll attribute it to this. If you'll instead pull all of that, any change you observe, you'll say, no, this is going to be an inflation on these sectoral shocks. So again, sorry for the nerdy questions, but whether these are overstating.
There, and finally, James. Huh?
I mean, it's a super interesting paper. Now, since the focus was on the inflationary impact, I feel it's important to remind ourselves that inflation is always and everywhere a monetary phenomenon. The problem with inflation, the buck stops here. It stops with the central banks. I mean, I understand the point that if there are global supply chain pressures, this may have come as a surprise to central banking, and maybe they were caught off guard. But it's clear that there still is a huge amount of liquidity sloshing around the system. You know, there's a lot of money meeting too few goods, and you know, that's a very old story. If it's global supply chain pressure all by itself, we're talking about relative price movements, and relative price movements by themselves don't cause aggregate inflation; they cause relative price movements. And so maybe that's a question back to you. You know, if you see prices having to go up in certain sectors, which you know, relative to which other sectors, which were the sectors that could give? Was it wages? And maybe if wages had to go down, maybe that explains why we now see the shortage of employment in many sectors. So, you know, there's an interesting flip side to what's going on here.
And finally, James.
Thank you, Jim Bullard, St. Louis Fed. So I love this paper, and I did think it was an excellent way to get at this supply shock issue. And I love the granular data and so on, the input-output. But I'm going to echo, I guess, the previous comments, which are that, you know, the ECB and the Fed are inflation targeters. We think inflation is up to the central bank in the medium term. So I think your statements should be that given the policy reaction, the monetary fiscal policy mix to the pandemic, we got a certain amount of inflation coming from the supply side of the economy. But there was some other response that could have occurred that would be a counterfactual that would have generated zero inflation over this era. And then we wouldn't be saying, you know, how much of it is due to supply shocks and how much of it is due to demand shocks. So I think it's taking the response to the pandemic as given, which in many other forums I've characterized as very, very good, both in Europe and the U.S. But taking that as given, then the supply shock accounts for a certain amount of inflation. So maybe that's a way to reconcile what you have with some of the previous comments.
Thank you very much. Sepnem first, and afterwards Gabriel. You have 2-3 minutes, or even a little bit more in your case.
Okay. First, let me thank Gabriel for great comments. And let me just clarify 2 points. All well taken. I fully agree that we don't have the trade costs, shipment costs. You know, that's obviously a limitation, but that is all will go in the direction of adding up. So our estimates are lower bound. And that's exactly why we stop at the end of 2021, the new shock, war, new shock, energy, protectionism, fragmentation, all these things are going to add. So exactly in that line. So we fully agree. We do have monetary policy. There is a zero lower bound. Remember, this paper is about to get to reality as much as we can. So zero lower bound, normal interest rate in closed economy. When we go to the open economy, we do several things between exchange rates, inflation targeting, nominal GDP. So, and our results are all robust to that. So it's not that we don't have monetary policy. We do have it, but there is a zero lower bound. And the imperfect competition comment, I fully agree. There are no markups in this model. But basically, these things are a little bit long run, right? We are trying to capture this end of 2019, end of 2021, very short run. You know, is this helpful to policymakers, real-time policymaking, and in a period where firm exit was stopped with the laws and regulations, right? So, but moving forward in the long run, of course, and you know, you can add markups to the model. I mean, we simplified the original model, so you can do all those things in the long run. So, the more long run issue. Okay, so Annette's question, we didn't do this, but you can do all this with this model, monetary policy, fiscal policy, how the multiplier would be different. I wrote a Jackson Hole paper last year with Pierre-Olivier Gorinshaw, Veronica Sander, and Nick Sander, and Veronica Penchovaca. There we did fiscal policy using a similar framework, and we showed that a very low fiscal multiplier in a world of supply chain bottlenecks. Here, we didn't do that, and that requires you have both policies, and you really need these hand-to-mouth agents, because that's what you really need for the stimulus, the entire stimulus to work its way. It is in their original model. Bakai-Fahri is very rich, very general model. We kind of simplify it to the bare bones, try to get at this inflation decomposition. But it is definitely doable. And interaction effects, they are there, right? So this is exactly how that simple equation, where we back out aggregate demand, and then the full optimization works out, where you have all the interaction effect and second-order effects between aggregate demand and sectoral demand and supply, and then the model gives you the composition. But going and pointing out within the context of multiplier, yeah, that's extra work. That's very interesting. We didn't do that, but it is doable if we go back to the richer model. Ricardo's question. So we use hours. We don't use employment from BEA and from ECB. Now, you are, of course, right that the policies implemented during pandemic is very different across Europe and across US in terms of people lose their jobs in US. Here, there's the retention schemes and all that. So I fully agree with that comment. Again, this paper we did last year for Jackson Hole look at exactly those policies and the implications of those policies. But you are also right. Even within this hours data we use, there is the potential one and there is the equilibrium one. They are both in there, right? This is, I think it's like identification problem. You have one data and you have two things that you are trying to separate within that data, and that's what the model structure helps us to do. Harold's comment and Jim Buller's comment, fully agree, monetary phenomenon, inflation ends at the central banks. Now, let me explain a little bit how we do this backing out of the aggregate demand shock. In the model, it's a discount factor shock, and all this liquidity put in the system, all the stimulus coming from all sorts of policies, this is a summary way of summarizing that. If you try to go and feed all that in, you have to do a much richer matching of these moments in data. A very simple way is this is a discount factor shock, aggregate demand capturing all those things. But in the model, there isn't this liquidity put in the system or the transfer, fiscal payments, and all that, right? But you can incorporate all that in. It's just that aggregate demand shock as a discount factor shock is a way of capturing that in a simple way. And again, we are not saying monetary policy shouldn't respond to this inflation. Of course, monetary policy should respond to this inflation. That was my last line. And I mean, it's just that inflation would have been lower. That's the way to read this result. Yes, there can be a world there could have been zero inflation. In fact, this is all, again, about the aggregate demand shock, exactly as you're saying. In the original Bakai-Fahri work, it is deflationary, actually. They do from January to May, and everything works through deflationary because aggregate demand shock didn't work its way through yet. So we could have been in this world, but we did a lot of stimulus. We are not denying that. But still, without this sectoral supply component, with that stimulus, remember, we matched observed inflation through this discount factor aggregate demand shock. The inflation would have been lower. That's what we are saying. Did I answer everybody? Yes, that's it.
That's it.
Yes, thank you
Gabriel,
so much.
you have 2 minutes.
Yes, I don't have much to add, actually. Maybe with the only exception that it would be great to use this type of framework to also look at optimal monetary policies. So what should central banks actually be doing in the face of nominal rigidities, facing these shocks? Something has to give, as Harald says. What is it that optimally should give? I think that would be an important and interesting research avenue.
Let me say one thing on that, because I just discussed this paper Friday on BIS annual conference by Jennifer Leo that does exactly that, optimal monetary policy with a full macro network model. And they develop a price index that central banks should target. And the index gives larger weight to sticky industries and lower weight to flexible industries. So they say you should target services and not energy. That's the conclusion of their optimal monetary policy paper.
Very good. So I think that, this brings us to an end. Claire, back to you, our master of ceremonies. And the next panel is going to be important because it's going to be about inflation expectations, that I think that in the dynamics of the inflation process are a crucial element. Claire.
Thank you, Mr. de Guindos, for doing such an excellent job of chairing these two sessions. Thank you to all of the speakers and the discussants. I'll echo what President Bullard said. I think you did an excellent job of shedding so much light on the supply side part of the inflation problem that's emerged during the pandemic and really showed why it's proven so much more persistent and been so much more pervasive than many of us expected. As for the first session, I found it a fascinating dissection of the diversity of the euro area's housing markets. I think you made a very strong case to show that when it comes to housing busts, the devil really does lie in the detail of the debt. We shall take a short break now, but please join us back here in the room again and online at 11:15 when we shall be discussing inflation expectations. Thank you. Welcome back. Different groups respond to the threat of inflation in different ways. Financial markets act quickly, businesses and the general public much less so, with expectations from their sides tending to switch only sporadically, but when they do so, dramatically. Today's third session seeks answers on which measures of inflation expectations matter and to whom. I'm delighted to say it will be chaired by Isabel Schnabel, a member of the European Central Bank's Executive Board. Ms. Schnabel, over to you.
Thank you so much, Claire, and good morning to everybody, and in particular to my 4 panelists. You only see 3 of them, but I actually now you see the 4th one. So Ulrike, unfortunately, can only join us remotely, but let me say we're very happy that you were able to still make it virtually. So those of you who attended our virtual ECB Forum last year may remember the lively panel that we had back then on the future of inflation. Charles Goodhart criticized in his intervention back then what he called the bootstrap theory of inflation. Namely, and he explained it as follows, as long as inflation expectations are anchored, inflation will remain anchored. Ricardo Reis was in the audience at the time, and I think it's fair to say that he strongly objected to Charles's fundamental critique, arguing that, and I quote again, so you see whatever you say here may come back next year, inflation expectations are very useful insofar as they reflect whether people believe in the central bank. This interesting debate gave rise to the idea to follow up on this important question in this year's ECB Forum. And I think it's fair to say that this panel could hardly be more timely. Back in September 2021, so that was the time of the last panel, HICP inflation in the euro area was standing at 3.4%, and it has now accelerated to a staggering 8.1%. Market-based measures of longer-term inflation expectations, the 5-year inflation swap, stood around 1.75 in September last year, rose to almost 2.5% earlier this year, and has now settled slightly above 2% in recent weeks. Survey-based measures of inflation expectations have gradually crept up towards our 2% inflation target, or have even moved above 2% as the median in our consumer expectations survey. In the baseline scenario of our staff projections, inflation is projected to stay high for an extended period of time, but to return to around 2% over the medium term. And these developments raise a number of important questions for policymakers, and this is precisely what we would like to discuss in today's panel. So what is and should be the role of inflation expectations in monetary policy making? Which inflation expectations do actually matter? Those embedded in market prices, those by professional forecasters, or those by households and firms? How can we detect risks of de-anchoring? And finally, how can policymakers ensure that inflation expectations remain well anchored when inflation is expected to remain above target over a prolonged period of time? So these are the questions that I want to discuss with my 4 excellent panelists, which I will introduce one by one as they speak. And it is, of course, natural to start where the discussion ended last year. So I'm delighted to give the floor to Ricardo Reis, who is professor of economics at the London School of Economics, and who last fall published a fascinating Brookings paper on losing the inflation anchor. At the time of our previous ECB Forum, Ricardo was of the view that inflation expectations in the euro area most likely would stay anchored. But he asked central banks to make clear that if inflation turned out to be permanent, they would do whatever it takes to stay within their mandate of price stability. So, of course, we are excited to hear how your views have evolved since then. Ricardo, the floor is yours.
Thank you. Oh, wait, my glass is going to fall. Well, thank you so much for having me to talk here about inflation expectations. And so let me try to give you where I think inflation expectations are in the euro area right now and what challenges they pose for monetary policy. But to start, how do we go about measuring expectations? As Isabel already noted, we have three options. We can ask people, and for that, the best publicly available data is the one produced by the Bundesbank, which has an online survey on consumer expectations with data available since 2019. And soon we'll also have one conducted by the ECB coming live. We all know, or not we all, some of you may know that when one asks surveys of people of expected inflation, you always worry about the fact that people have biases, they overreact to news, and more generally that over the last 20 years when inflation was very stable, the signal to noise ends up being very small, partly because there is so much noise in this data. Moreover, not only we can ask people about expectations 1 year ahead, or we can ask them at longer horizons. But whether you ask 3, 5, or 10 years, you tend to get the same answer. Indeed, the Bundesbank asks 5 and 10 years ahead and pretty much gets the same answer, showing that people really can't distinguish that much between these different horizons. If you ask markets, the best publicly available data is the ECB survey of professional forecasters, now complemented again soon with the survey of monetary analysts. And that on the one hand has a lot of signal to noise and does quite well in the previous 20 years, but suffer from strategic behavior. Many of these professionals want to look different from others. After all, often they're paid for their advice, and that advice better be a little bit different than everyone else. But at the same time, they suffer from conformism insofar as they spend a lot of time in conferences like this and end up being driven by the arguments in it. And more importantly, as in that Brookings paper I noted, if you look at the record of when we had large turning points and we had good professionals data, early 1970s US, inflation going up, Volcker, inflation going down, the professionals were way off. They really were they were as surprised as central bank, I guess, is a way of putting it. Third option is to measure market prices using inflation swaps, options, in the case of the US, break-evens, in the euro less so, where the difficulties there is that you need to take out compensation for risk, and we know how the price and quantity of risk in markets changes a lot, as well as just noise having to do with liquidity and all kinds of trading frictions beyond adjusting horizons and payoffs. Let me do that. Let me look at these three types. By doing that, I'm plotting here from the Bundesbank 1 year ahead the expected inflation. Important, you need to adjust it, and I have a simple formula there that you barely can read that comes from previous work that I had to adjust for standard deviation and skewness, which is a very simple way to back out the noise, to take out some of the biases of people. The markets in blue and the professionals in green. It's clear that in 2021, households started moving faster a little bit than the markets did, but both very much together. And then in 2022, we have especially the market prices rising significantly more as perhaps you start having risk compensation increasing as a recession became more likely and high inflation starts being associated with a recession. Therefore, making sense of why blue got a little bit steeper than red after they had moved together. The professionals were mostly useless in detecting the increase in the inflation 1 year ahead. And notably, in the last 3 months, and as we expect the new wave of the Bundesbank survey, which will come pretty soon, what we see is actually that from the markets, the older we have, very steady market prices, if anything, a reversal as monetary policy tightens. And again, let's wait for what the people think. That's the 1 year ahead, and one that we can judge and say, well, some people were, apologies for my rudeness, a little useless insofar as we already know a little bit what the inflation was or is very likely to be. But let's look at the harder question, but maybe the more important question. What if it looks 5 years ahead, and where perhaps we can also average over the biases and overinterpretation of people? Well, 5 years ahead, you see a very similar pattern where households increased, markets much more after January, and again, the professionals lagged behind. So if you want to think about whether inflation are anchored in the sense of the next 5 years, you get a similar image of somewhat of a de-anchoring starting after I made those statements, Isabel, and speeding up at the beginning
of this year. Now, this, if you want, looks at all three of them, but in trying to, instead of pick between the three, why not use a method that tries to combine them to come up with a method? And here's a lot of equations to convince you that I'm serious, but this is all to say that these are a model that tries to extract some of the biases, allows for overreaction, sluggishness, and essentially combines these three lines, these three series, with measures of disagreement and skewness that allow you to put more or less weight on the people versus the markets. If you do that, here is what Eurozone expected 5-year inflation is since starting in 2024. I purposely did not put a number in the vertical axis. Why? Because that's an assumption. I have to start it somewhere. If I started at 2, then expected inflation would have risen to 5. Started at 1, it will have risen to 4. What happened? Why does it increase in these two steps? Well, first, when one looks at the data to decompose what the model is doing, is that skewness and dispersion increased at first in mid-2021. And then, as the market prices rose, the model says, aha, indeed, expected inflation must have increased. First, the skewness and dispersion, then the asset prices, finally the median changes. What happened in the very last data point? The very sharp increase in markets, and given the difficulty in this model accounted for change in composition of risk, maybe perhaps lead to an overstatement. So I don't completely buy that last number over there. Let's wait for a little more data. It's probably 0.5% to 1% lower. Either way, the new anchor, if before, let's say, was 1%, now seems to be 2.5%, or maybe even as high as 3.5% or so, according to what the data on expectations is showing. Why is that? Well, the picture from the Bundesbank survey shows it somewhat clearly. This is the histogram of the answers that people are giving. And what you see is that it's not just that expectations are unanchored in the sense of a flatter distribution. The distribution has shifted horizontally to the right now, to 1.5% to 2% higher. If one starts from the perspective that, now, let's, good and bad, glass half full, glass half empty, is on the one hand, they are stable now at somewhere like, again, 4% here. Once it corrects for biases, compensation for risks and others, one could say it's more like a 3 to 4% is the right amount. And note, before you start dismissing, oh, households, I go to too many conferences where people say, oh, these households, they don't know what they're talking about. Remember how they were pretty much on track, not so the professionals, when it came to the 1 year. And now, think about it. If inflation is 8% this year, 5% next year, 3% the other, and 2 and 2, that averages to exactly 4%. That does not seem like a crazy, out-of-touch household. May not be the outcome one wants, but certainly one that seems somewhat plausible. Moreover, perhaps German households are particularly sensitive, and therefore this is an upper bound. But this is to say that this is a reasonable estimate. On the other hand, is this a worrying estimate? Perhaps, if for 5 years, average, again, having an estimate around 3.5%, 4% seems reasonable. If instead it was 4% in a 5-year horizon, that would be worrying given a target of 2. But as I told you, you really cannot torture the data to tell you that because the people just don't distinguish this very well. And moreover, it is not that now expectations are an anchor. They are anchored at some number above the 2% target. Whether that's 2.5, 3, I don't know, but certainly somewhat above 2. If you want to look at longer horizons than a 5-year horizon, then you really want to, the only way you can do is markets. Markets do separate 5-year from 5 years ahead. And there, like I said, you struggle with separating for plausible risk premia. This increase all in the Eurozone 5-year expected inflation, I think can be too glibly dismissed as purely compensation for risk. That would be a 1.2% in compensation for risk change in inflation. That's what some of the estimates from the ECB models would say. It's very hard to write a model that has a 1.2% increase in a risk premium with no change in fundamental whatsoever over this period. But let me leave it at that. To say instead that if one looks at the distributions, skip ahead. If one uses distributions to back out instead these probabilities of inflation being high in this 5-year horizon, what one gets is that the ECB, and takes that as a measure of credibility, insofar as being this far horizon, one gets a perhaps worrying, perhaps not shocking, increase from essentially 0 to around 6% around January, December. But since then, very little change. These are the very last numbers that I calculated 2 days ago. For June is the last number. You get, again, a likelihood, if you want, that maybe the ECB will not be able to control inflation at 2% at this long horizon, which again seems credible. And again, glass half full, glass half empty. But should you care? Having looked at the data, I conclude that expectations seem reasonable, sensible. The data is giving sensible things. And they say that perhaps the inflation expectations are a little above where the target is and with a risk of staying above higher. Should you care? Well, for that, you need a model. And so let me write the simplest New Keynesian model, the three-question Keynesian model, because I thought it would be the more familiar to this audience. But I think the points I'm going to make are independent of really the model itself. What happens when you have rational expectations? Well, expected inflation stays on target, at the target being pi upper bar. And the actual inflation deviates from that insofar as we have either shocks to potential, what I called here A, where if you have if you're a very hawkish central bank with a high phi, then you really kill those, and you achieve the so-called divine coincidence. And in response to instead a supply shock to the gap to inefficient potential, well, inflation again rises, but how much depends on how dovish you are. And if you are infinitely dovish, you really let interest rates respond a lot to any deviation of output gap, then you end up with the Z coefficient there goes to 1. Essentially, all of the shock goes to inflation. So then, what happens if we have measures of expected inflation, pi e, that you measured, the numbers I showed you, and that turned out to have gone up? Well, if they are pure noise, you should not respond to them. Theta should be 0 in the response function of the central bank. Of course, if they're pure noise, you're just introducing noise to monetary policy. You would be tightening too much by responding to my, things seem to be a little bit above 2, perhaps. But what if people, in all their stupidity, wrongness, answering things wrong, act on it? That is, they, from the first equation, what if people expecting inflation set higher wages and or set higher prices in the case of firms? What if people, expecting higher inflation, therefore taking account of lower real returns on their savings, decide to spend more, and through hand-to-mouth, end up, again, expecting inflation comes with more consumption spending? Well, if that is the case on both of them, then you want definitely to respond to expected inflation. For even if this pi e was a deviation from expectations, as long as people are responding to it, they are pushing up aggregate demand, they're pushing up aggregate supply. They're just raising wages, raising prices, raising consumption as a response to it. What if instead people, when they're raising their inflation expectations, are overreacting to supply shocks? Maybe it's all about the supply shock Z, but that Z sadly comes with, again, these very, very terrible citizens that we have to shepherd, coming with raising their inflation expectations with a coefficient beta there that can be maybe small, maybe large. Some people often will say, oh, people just overreact supply shocks. They shouldn't be doing it. Again, if they do, though, they're going to spend more, set higher wages, set higher prices. At a minimum, the central bank wants to overreact as much as they do, and potentially more, depending on how much you care about inflation, output, and how dovish or hawkish you are. But if people overreact, they not overreact in their survey answers, they overreact in their behavior. And if they overreact in their behavior, then to offset the inflation that comes from it, one has to overreact as well. And finally, what if instead it's long-run creditability? What if instead these overreactions are coming up as a deviation of expectations that persists over time? In that case, the central bank, in order to keep inflation on target, need not just react to it, but actually react extremely swiftly and very aggressively. This is sometimes what's seen as the unanchoring of long-run expectations. For that is the only way to keep to prevent a prolonged and very large deviation of inflation from target as a result of those unanchored, slowly moving expectations of inflation that arose. So again, now you want to have a very high theta, a theta that's at least as large as delta, that is the extent to which people are myopic in their expectations. To conclude, if policy is just not, only and only if you think that the drift up in expectations is pure noise that no one is acting on, nothing in the short run, nothing in the long run, should you ignore it. Otherwise, a movement up implies a tightening, and how much one tightens depends on whether you think it's driving actions, responding to market shocks, leads to more reaction, and doubts on credibility. To conclude, can we measure expected inflation accurately? No. And yet, we can look at data and get signals. And the signals that come, looking both now exposed to the performance of how people perform expectations a year ago, and now that we have a year of data to see the inflation, tell us that, and then contrasting that with the 5-year expectations, give a coherent account that, in my view, makes it hard to dismiss expectations as being irrelevant or a bottle something theory. I forgot what the name was that you said, Isabel, that Charles had said last year. What is the best measure of expected inflation? Isabel asked in introduction. None. Better to combine them. Combining them suggests an anchor that is somewhere around 3 to 4%. On the one hand, fine, that may be consistent with even projects what inflation will do. On the other hand, concerning if it persists, but with some upside risk. Longer horizons, is the ECB target still credible? Yes, it's a small probability of 5-6% that is being revealed by the market prices, but at the same time, there is a little bit of that upside risk. And so given the upside risk, both in the short run and in the long run, should a central bank respond to noisy upside risk? And the answer is that unless you're very confident that this is truly noise, then not even the guys saying are taking seriously. They're not even taking themselves seriously, the response to surveys. Otherwise, it suggests tightening with a different vigor depending on whether you think it is driving the measures up. And I've gone way over time, apologies, but answer to Charles Goodhart, measure expectations matter for monetary policy. Thank you.
Thank you so much, Ricardo, for an excellent presentation. Let me now come to the second speaker. So I'm delighted to welcome Loretta Mester, who is President and CEO of the Federal Reserve Bank of Cleveland and a very vocal member of the Federal Open Market Committee. Not so long ago, Loretta said in a speech delivered at another ECB conference that a risk management perspective argues for caution because inflation risks are to the upside and because the longer inflation runs above our goal, the higher the risk that long-term inflation expectations will become unanchored, thereby making the return to price stability much more costly. We are very happy to hear more about how the Fed is using such a risk management approach. So thank you so much for being here, Loretta. We are very much looking forward to your intervention.
Okay. Well, thank you, Isabel. Thank you, fellow panelists, and thanks ECB for inviting me to speak today. I'm really happy to be here, and the whole conference has just been wonderful. So what I thought I would do in brief opening remarks is talk about inflation expectations from a practitioner's point of view and a practitioner from the US. So I thought I'd talk a little bit about theory, a little bit about practice, and then sort of an approach. So very simply, inflation expectations have been a central feature in models of inflation dynamics since the 60s and 70s. Phelps, Friedman, Lucas all talked about the role of inflation expectations. And they do play a key role in the new Keynesian DSG models that are used to inform monetary policy at many central banks across the globe. Now, in many of the central bank inflation models, some measure of a resource utilization gap helps to determine inflation. Lagged inflation is included in the models to capture inertia in the inflation process. And some measure of inflation expectations is included in the model. And the different models put different weights on these three factors, but household and business expectations matter since they affect wage demands and offers, and therefore the firm's price-setting behavior. And the Cleveland Fed has an institute on inflation and inflation research, and they've been doing a lot of research, and they've found that including measures of inflation expectations actually improves the inflation forecasting models, although I know there are papers out there that find that they don't improve them that much. Anecdotal information indicates that businesses do base pricing decisions on their expectations about inflation. And there's recent research that documents that high inflation expectations cause firms or lead firms to raise their prices. The inflation expectations, and this is something Ricardo talked about, also provide an indication of how credible the public finds the central bank's commitment to achieving its policy goals. So if you look at the Federal Reserve's monetary policy framework, it emphasizes the role of well-anchored inflation expectations in helping to maintain and achieve price stability. And it wasn't until 2012 that the FOMC actually first established an explicit 2% longer-run goal for inflation. And then when we revised our statement on longer-run goals and monetary policy strategy in 2020, it really emphasized the role that the committee puts on longer-term inflation expectations that need to be well anchored at 2%, and their contribution to helping us achieve both of our policy goals, full employment or maximum employment and price stability. So Now, the problem is there's various ways to define well-anchored. So here, I'm going to be using well-anchored to mean longer-term inflation expectations that are insensitive to the data and are at levels consistent with 2% inflation. And of course, this definition then would depend on the public understanding the central bank's inflation goal and how strongly it believes the central bank is committed to returning inflation to goal when it's deviated. So what that underscores is the role, or the very important role, that central bank communications plays in really keeping inflation expectations anchored, and via that channel, communications can help mitigate the persistence of shocks to inflation. So, if you go back to the three factors here, inflation expectations that are anchored can help mitigate the pool of resource gaps on inflation, and therefore, the cyclical movements in interest rates that policymakers induce to maintain price stability need not be as large as when inflation expectations are not well anchored. And I think this is consistent with what Ricardo just talked about. And that's particularly useful at the zero lower bound when it constrains interest rates. So, arguably the US would have had much lower inflation during the Great Recession had inflation expectations not been relatively stable, offsetting some of that influence the negative output gap had on inflation. And similarly, in the face of today's very high inflation readings, if inflation expectations were to become unanchored, then their influence would offset the impact of any beneficial change in the output gap, and monetary policy would have to act much more forcefully to return inflation to the goal. So I think the theory is very compelling. I mean, I think, theory is very compelling. Real world doesn't always cooperate. So, you remember Japan, right? For a long time, inflation expectations have run well above their actual inflation rates for a number of years. So one of the first things a policymaker has to do is to confront that, the theory speaks of inflation expectations, but those expectations are not directly observable. I mean, in the model, if you have a rational expectations model, right, the unobservability doesn't come into it because the inflation expectations are model consistent, so you can calculate them. But in the real world, that's not true. So we look at a number of different measures, and Ricardo showed a number of measures for the Eurozone. These measures differ by type of agent and time horizon. And there's measures based on consumer surveys. There's surveys of businesses. There are professional forecasters surveys. And then there's the measures derived from financial markets. Now, in practice, I think if you want to get an indication of where inflation expectations are and where they're going, you need to look at all those measures. You can't just pick one. But when you do that, you see that a clear signal isn't always forthcoming. Some of the measures move in different ways. And the research just shows that different groups of agents can behave very differently from one another. The literature has not informed us, not firmly established, whose expectations matter most for inflation dynamics. And even within a particular group of agents, even if you say consumers, there's considerable heterogeneity across consumers. So we're doing some measures which we call indirect consumer inflation expectations at the Cleveland Fed. And basically, it's an idea based on indirect utility. So you ask the question, okay, given the basket of goods you buy, so it's personal to the person answering the survey, how much would your income have to rise in a year or a 5-year horizon for you to be as well off so you can still afford that basket? So in other words, rather than sort of ask them directly, tell us what what's your expectations of inflation, a lot of our work says people don't even know what inflation is, right? What's this indirect thing? If you look at that, what we get in the data is these expectations of inflation from this indirect measure, and this is in the literature elsewhere. They vary by demographic and socioeconomic factors. So women tend to have higher expectations than men. More wealthy people have higher expectations. So again, that isn't really in the models that we have. The prices of particular salient items like food and energy also seem to affect inflation expectations. They can have outsized effects. The empirical results also show that we don't really understand the direction of causality, right? It's not clear. So, do high inflation measures cause inflation expectations to rise? Or do higher expectations about inflation affect the decision making, which is something Ricardo was getting at, leading to higher inflation? Or is it both? So it's a problem because you have to then infer something, and it's not even clear from reduced form estimates which way it goes. And the other thing we know is that while businesses are the ones that set prices, we only have limited information on inflation expectations for businesses, although work's being done both in the ECB is doing work and the Fed is doing work to try to increase our knowledge of business expectations. I think another very practical consideration for policymakers is how to assess whether inflation expectations are becoming unanchored from the target. And relatedly, the level of degree or the level of the central bank's credibility in the eyes of the public. So you can look at levels of longer term expectations relative to shorter term expectations to get some indication. For example, if longer term expectations are stable in the face of a positive shock to inflation, then that would be some indication the public believes inflation will come down. Although it need not indicate that they believe that monetary policy will be the main driver of that reduction. And in addition to the stability of the mean or median level, dispersion across survey respondents might also indicate how well inflation expectations are anchored, with lower dispersion indicating better anchoring. So I think we need to be looking at all those measures. We have to look across different actors, agents in the economy, to understand their expectations. And we need to look at more than just mean or medians. We need to look at distributions. Policymakers also have to contend with the possibility that financial markets may have more confidence than the general public in the central bank's ability and commitment to bring inflation back to goal. And I think that, again, it suggests that policy communications are going to be important for keeping inflation expectations anchored. So taken all together, the research suggests that there's still much to learn about how inflation expectations are formed. Yet, as a policymaker, we need to make decisions based on the limited information we have. And the recent data in the US indicate that longer-term inflation expectations are still below current inflation readings, so you might infer that the public expects inflation to come back down from its unacceptably high level. But if you look at measures of longer-term expectations, they are rising at longer horizons, and that's problematic. And if you look at dispersion, and this is household expectations, that dispersion across survey respondents is also increasing. So this is looking at dispersion measured by the 25th percentile and 75th percentile in the University of Michigan inflation surveys. So I think the fact also that salient prices like food and gasoline remain elevated suggests that there is some risk that longer term inflation expectations of household and businesses will continue to rise from the current levels. So what do you do in the current situation? From a risk management perspective, I think it's important for policymakers to ask which situation would be more costly. Erroneously assuming longer-term inflation expectations are well anchored when in fact they're not, or erroneously assuming that they're moving with economic conditions, and in this case moving up, when they're actually anchored. And if you do simulations using the board's Furvis model, they suggest pretty strongly that the more costly error is assuming inflation expectations are anchored when they're not. If they're drifting up and policymakers treat them as stable, what ends up happening is policy will be set too loose, inflation would then be moving up, and this would be reinforced by increasing inflation expectations. On the other hand, if the expectations are actually stable and policymakers view the drift up with concern, policy will initially be set tighter than it should, and inflation might move down and might even go below target, but not for long, because inflation expectations are anchored at the goal. So those simulation results, coupled with the research suggesting that persistent elevated inflation poses an increasing risk that inflation expectations could become unanchored, strongly argue against policymakers being complacent about a rise in longer-term expectations. I think it's important to remember that inflation expectations are determined not only by movements in inflation, but also by policymakers' actions to follow through on their strongly stated commitments to return inflation to the longer run goal, thereby justifying the public's belief in the commitment. So obviously the current inflation situation is a very challenging one, both here in Europe and in the US. Central banks are going to need to be resolute, and they're going to need to be intentional in taking actions to bring inflation down. If you think back to the low inflation we had in the pre-pandemic expansion, that really led to considerable research. The ECB is at the forefront of that research, as is the Fed, on how low equilibrium interest rates and the zero lower bound can create a downward bias to inflation and inflation expectations. And the policy implication that some drew from this research was that if policy had to err, it should err on the side of being too accommodative, since it would be easier. I'm going to emphasize that it would be easier to address high inflation than low inflation. Okay. I think the current situation, very challenging one, in which a sequence of supply shocks have contributed to inflation being at a 40-year high, belies that view. I think it also calls into question the conventional view that monetary policy should always look through supply shocks. In some situations, such supply shocks could threaten the stability of inflation expectations, and they would require policy action. So my hope is that this situation that we're in, just as the period of low inflation generated important research, that we'll have a new burgeoning research, and we saw some of it actually this morning, to help us actually understand more about high inflation, the role of expectations, and how supply conditions matter, as well as demand side factors. So thank you very much.
Thank you very much, Loretta. So I must say you were very consistent with what you said 6 weeks ago, but I'm not surprised. So our third panelist is Ulrike Malmondier, who is a professor of finance and economics at the University of California at Berkeley. So I'm very happy that you can join us remotely. This is very much appreciated. And as you probably all remember, Ulrike has not only explained to us why we pay for not going to the gym, but she has also done some fascinating research on the formation of inflation expectations. And she is...
Sometimes older generations are more pessimistic, sometimes younger generations are more pessimistic. Sometimes the different generations have pretty similar views on inflation, and sometimes there's huge dispersion. And noteworthily, in particular in the period of the 70s up to 1980, there was increasing dispersion up to 3 percentage points at the time. Now, it turns out if you're trying to predict these cross-sectional differences, after accounting for your usual suspects in terms of demographic, wealth, education stuff, but even monetary policy with fixed effect, that individual level lifetime exposure to inflation is enormously powerful. Those are the fitted lines I drew in here, the solid and the dashed lines. It turns out that if you give me your birth year, I get data on the inflation you have experienced over a lifetime so far. I average it with somewhat declining rates. There's some recency bias. I get a lot of predictive power. So our personal experiences seem to stay with us. We tend to put more weight on realization of experience over our lifetimes than other historical data. In some sense, this is a relative of the adaptive learning models, but the big difference is that it's crucial not just to say, oh, people overweight recent realizations. Everybody puts too much weight on the last year or last 5 years or whatever you prefer. No, it depends. If you're 20-year-old, you have seen, what happened in the last year or two, and then before that, you have not seen. If you are 60-year-old, you remember the 1980s.
Ulrike, we have a slightly broken connection, so maybe it's better if you turn your video off. I think then we can still see the slides, right? That's possible.
Yeah,
maybe that's better because we sometimes lose your voice, unfortunately. Thank you.
Okay, and please interrupt again. I'm happy to kind of just go back a slide. But what I was trying to say here is that there's lots of data now on past realizations having an overproportional influence on our expectations, actually not only in inflation, also in the stock market, for example, in unemployment experiences. Stay with us, we remain cautious spenders for years to come, even if life cycle consumption savings models would say otherwise. And these effects do not only affect what we answer in the survey question of inflation expectations or other expectations, they affect actual decisions, as also Ricardo alluded to, in this case, investment long-term bonds. Are you shying away from it? Do you buy a house or not? Do you use a fixed rate or variable rate mortgages, etc.? Now, while I'm focusing here on households, I do want to pause and say it's not only households who exhibit this behavior. In one of their New Zealand manager papers, this one, the Brookings paper by Kumar, Afruzi, Quabian, and Gornichenko, they asked managers of the New Zealand firms, how do you typically form your inflation expectations? And the top 4 answers included shopping experience and prices of competitors and suppliers. So in other words, the prices they see around themselves right now in the recent past have an overproportional impact on their forecast of future inflation. There's also meetings and discussions, so information you get from other people, but it's not financial advisors, it's not monetary policy experts, it's actually people like me, co-workers and family. And it seems to be the case that information coming from people who identify with information that resonates seem to have an impact, and maybe we can get back to that later in the discussion, thinking about what the central banks could do. But finally, after covering households and firms, I do want to talk also about monetary policymakers themselves being strongly affected by their prior experiences. So my favorite example is a guy born as Heinrich Wallich in Berlin, in Germany in 1914 into a family of bankers, lived through Germany's hyperinflation in 1923, and then emigrated to the US in the 1930s, where he had a very successful career in the Fed system, first in New York Fed, got a PhD at Harvard, Fed governor from mid-70s to 80s. To my knowledge, he still holds the record in Federal Reserve history of dissenting the proposal of the chairperson and kept warning people that they don't understand the dangers of inflation, how it's around the corner, it's imminent, etc. So why I love this anecdote so much, and I think right now Henry Wallich would appreciate being cited during the current period, is that this is clearly a highly educated person, has all the inflation data at their fingertips, models available, knows that he's in a different country in a different time period and still cannot shake that experience. But I do not have to go to him. I can also look at the semi-annual monetary policy reports and the forecasts, one-year forecasts members make in those. If you correlate them, if you plot them again, they're personal experience-based inflation forecasts. So I get, Loretta's and everybody's birth year, look where they lived and calculate their lifetime average of inflation experience. I get to predict why they deviate from their staff forecast, and very strongly so. So why is that? Why do our personal experiences stay so strongly with us, even if we are highly informed, know the models, etc.? Why does it on the margin push us quite strongly in one direction or the other? The message today might be that we should pay a little more attention to neuro rather than knowledge, whether we have the information. We should acknowledge that as living and breathing organisms, our brain keeps changing as we walk through life. Every new experience leads our brain to form a new connection between neurons. These synapses tell our body to react to the world, how to react to the world around us. Importantly, for the inflation situation we are discussing, how often we make an experience matters. So Loretta mentioned repeatedly gas and food prices, which get this overproportional weight. That's exactly consistent. If you have repeated stimulation, or particularly over a prolonged time, that causes long-term potentiation. Every time you go to the gas pump, you see the higher price, you can just not stop your brain from forming a strong association between gas and high inflation fears. In fact, the word fear is important here because neuroscientists talk not only about synaptic tagging, but emotional tagging. Emotional events attain privileged status in memory. So if this would result in some kind of panic, anxiety, fear, that's how we ensure that's really deeply ingrained in the population, which of course we would want to avoid. Learned knowledge, as much as we finance professors think we can fix this by explaining the seasonal AR4 model better of inflation, has very limited power to undo this. I think a good reference is the literature on trauma, how synaptic changes are caused by traumatic stress. And it's a good reference also because trauma is not only the big T trauma, the, traditional, in the neuroscience literature, the war experience, adverse childhood experiences, or in the econ environment, the German hyperinflation or Great Depression or pandemic. No, there's small T trauma. The daily exposure to increasing prices, even if that doesn't completely destroy your livelihood, the daily worry about food insecurity, unemployment insecurity, which reshapes and reforms our brain and leads us to think differently about the world. One of my favorite examples are those gender differences, which I saw Loretta also mentioning on her, I think, third slide. There is now, I think, over 50 years of evidence, maybe starting from a old paper with Swedish data, that women tend typically to have higher inflation expectations. So when we did a survey, we found this even during the low inflation period, this data up to 2015-16, even within households, the male and female heads of household differ in their inflation expectations, controlling for everything. Where does that come from? Well, it's not literacy, it's not education. It turns out that the prices males and females see in their daily life have a lasting and strong impact. So what we did, for example, is to look at who does the grocery shopping in your household. So traditional gender roles makes that very much the woman still. However, in those households where the man indicated that they do at least some of the shopping, the gender differences in inflation expectations completely disappears. And that, of course, then reflects the highly volatile food prices where people tend to latch on to the increases rather than decreases. So to conclude, in terms of implications for monetary policy, the experience effect perspective kind of highlights the 3 or maybe 4 things. First, frequency of being exposed to signals is really important. This explains the overproportional roles of food and gas prices, personal shopping. So from a monetary policy perspective, it will be important to acknowledge it and understand that that's the lived reality of consumers, rather than just saying, well, those high volatility items, they really just obfuscate actual inflation trends. Let's just focus on core inflation. If we do want to understand where expectations come from, we need to acknowledge frequency more. Similar to duration, inflationary experiences are extra powerful if they remain high for a long time. The effect will last for a long time. So you might want to account for that in your policy choices, that once we're back to before, we're back to 2014-15, people will still be different. They will still make different spending decisions and form different expectations. This is particularly true if these events get emotionally anchored. Panic means strong anchoring in memory. So obviously, it is key from a monetary policy perspective to try and combat that, but not by kind of trying to teach people, oh, food and gas, that's only 15% of a typical urban consumer's consumption bundle. No, acknowledge that's their lived reality and reassure it. Maybe use more resonant channels of information conveyed by people which know their world, with its managers, which live in their managerial world, face those prices to convey this information. And then finally, I also wanted to talk about the anchoring topic, which is of course on our mind. And to some extent, the perspective of experience effect breaks a little bit the link, maybe to the usual way we think about credibility. Right? So normally we think of inflation as well anchored around, say, the 2% target. Oh, that means the central bank is credible and can, pursue effective monetary policy. The perspective I have been giving you says, well, their expectations very much reflect what they have experienced. So if that says 2%, they will answer 2%. And if that says 5%, they will say 5%. It does not necessarily undermine the credibility in the sense that the central bank is not clear on their triggers for decisions and is not following through, etc. So expectations are important in that they show whether the central bank is doing its job, but just in the sense of fighting inflation reality, then the credibility. As a result, some of the monetary policy topics, such as forward guidance, might not be as powerful as we have thought. Now I'll stop here.
So thank you so much, Ulrike. I think I didn't promise too much. So I very much hope that you are also going to talk in the discussion a bit about the kind of innovative proposals that you had, how we, what we can actually do to also, reach these portions of the brain that may at the moment be affected by high inflation. So we're now moving to our final speaker, who is Erik Nielsen, a Group Chief Economic Advisor at UniCredit. So he is the person sitting every weekend in a Berlin cafe to write his very popular Sunday rap, to which one may not always agree, but which is always thought-provoking. And we're, of course, very curious to hear your views a bit also from the market's perspective.
Thank you very much.
Thank you very much for being here.
Thank you. Thank you. Thanks for having me. Thanks for inviting me to Sintra again, and thank you for inviting me to this panel. Very honored to be here. I am, as you said, or like Ricardo said, I'm from the dark side of the markets who are not only paid to be different, but also always wrong, I think you said. So let me try to give you the perspective from the market. And not only markets in terms of financial markets, but also markets in the corporate sector. We are a corporate bank. So my most interactions with clients are actually with European corporates and what we hear from them. So I try to give you a sense of this. Certainly one thing I would say is that the conversations in markets, both financial markets and corporate markets, picked up very dramatically this year. I mean, this was the discussion of inflation is something we did talk a lot about before, way back to some extent, but certainly this has picked up. So this is a really hot topic and very important, obviously. If I can just summarize, the key message I hope you take away from what I say today is the following. Inflation expectations, certainly the medium-term to longer-term inflation expectations, are definitely really important for the credibility of the central bank. No question about it. I will not doubt that one moment. But my sense, in my assessment this year, the amount of, or the impression I get is that the use or indicating changes to the steps, I think is excessive. There's a risk of being too pointy. Monetary policy, I don't need to tell you, but monetary policy is more an art than a science. And yes, data dependent, but my key message here is that I worry a little bit that there is paid too much attention to it. And let me try to illustrate that very quickly by sort of two segments on what I'm going to say. First, the market-based inflation expectations. I have sort of two key concerns. Number one, what Ricardo talked about with a five-year, a little bit dramatic how it's gone up. Five-year is volatility. It came down, as Ricardo said, I'll just remind you, we were down at 175 earlier this year, then it jumped up or moved up to 2.5, and then less than 3 months ago, and now it's back at around number 2 or thereabout. Which, if I were a central banker, I'd say very good. No drama, people are believing in us, and rightly so. But it's volatile, right? So, and remember, I don't need to remind you, but monetary policy has a policy-relevant horizon, which is not a point that I have, or the worry about the market-based, or what we read in the markets, is what you have said in several of your speeches, and Philip Lane also, and others, which is that it's kind of a messy instrument, right? It's if you have to try to take the liquidity and risk premium out, and I could have shown this chart that you had, Isabel, a couple of months ago in one of your many fantastic speeches, where you looked at the inflation risk premium on a 1-year, 3-year ILS. And what I saw from that was that premium moved from deducting 80 basis points early in 2020 to adding 40 basis points at the time you spoke, and it's about the same place now, I think. That's a whopping 120 basis point shift in that noise inside what would have been the policy relevant period, right, from 2022 into 2020 into now. So interesting, and it's important work, but I take away from this that this is again, as I said, too volatile and too many distortions. And I know I'm stepping into dangerous territory now, but it's looking at that as a guide for policy direction. It's a little bit like the focus on the neutral rate. Neutral rate, fantastic economic concept, wonderful. Exposed, ex ante, we don't really know. So this is a really, I think it's an important thing to do, to worry about. In other words, And this comes now to Ricardo's point of my professions, having spent my life. If you adjust the market-based inflation expectations for the noise, it really becomes not much more than a weighted average of professional forecasters. And we have not been very good. Right? It's like the fact is that I've done this for 25 years, and I will eat humble pie with anybody around here. We've been terribly wrong. I mean, the fact of the matter is the market's price is something they expect, but they don't know anything about the future more than we do or you do. So it's like, so to be too using it as a tool, I worry about. Now, that leads me then to just a more sort of anecdotal side to this. It's a good time to tell you that since the ECB, which is part of the major central banks I spend more time thinking about with clients, sort of moved on from financing conditions as a key measure that was always measured or talked about to normalization, and then inflation expectations, an enormous increase in conversations picked up. So clients called from the financial markets for corporates and what have you, an enormous rich discussion pursued. And the only thing I can take away is that even market professionals suffer from the same thing as research shows that the general public and corporates and households suffer from, which is basically a lot of lack of knowledge, probably. Many people don't really know what inflation is. I mean, sort of what index we are talking about, what's in it. They generally, until a couple of months ago, overestimate what inflation actually is. They also do not seem to know, most people, that generally speaking, inflation expectations have been higher than actual inflation turned out to be. So there's a lot of confusions out there. That was the first segment, and I am right on time. The second point I want to talk briefly about is the survey-based. And I'm only talking about the medium longer term. I think short term should not really worry anybody. And I have three observations. The first one, they are also prone to change or revisions. And I will say with all respect that when the University of Michigan revised its inspection number last Friday, I have never spent so much time talking to financial market participants about a revision of a number from 3.3 to 3.1, and we know why. So this was become the only conversation the markets had for a good long time. So that is a one thing to maybe keep in mind. It's one number. Then there's a second question, which is reflecting what I said before, namely that is from my conversation with our corporate clients, who are often, many of them part of the surveys, not completely clear that they know what they're being asked or what they reflect on. There is often confusion between micro and macro. Do they talk about input prices or can they put on to output prices? That's the conversation now. There are questions about the index, which one it is. Is it an index they care about, or their personal or their business index? And for bigger or more senior corporates or clients, it's often then confused with asset prices also. So there's a lot of noise in this that makes me somewhat nervous about the usefulness of it. So this leads me to my final point, which is the only reason why inflation expectation may matter, obviously, is the risk that they lead to higher wages and then the self-fulfilling story. And that is certainly something that I respect and I know is a very important. I'm not so sure. I mean, we know economic research shows there is a good correlation, a very strong correlation, but I'm still somewhat nervous now. I can see the ECB's concern about the upcoming wage negotiations, in particular Germany, and the effect of the indexation of minimum wages in France and other places, and then the spill through, of course. I respect all this. I suspect, and I would love to be told I'm wrong, but I strongly suspect that when you see credibility, I understand that, but maybe, and I fear a little bit from what I sense from my standpoint, is that there's a little bit too much attention to trying to pick numbers that sort of gives you the story that explains it. And then the risk is that one picks individual numbers that are very, very volatile and maybe not so meaningful. So my 2 cents worth would be that we all understand it's very, very difficult to run monetary policy, and I wouldn't set policies on the basis of 1 or 2 individual numbers. Thank you very much.
So thank you very much, Erik. Actually, I have a short question and comment on what you said. So I was surprised that you said that risk premia are not said they actually contain useful information about the uncertainty about inflation going forward. And therefore, I would not say that we can say it's simply noise. And the question related to that is, a couple of years ago, when inflation expectations were going down, did you have the same interpretation of the risk premia?
To be honest, I don't really know. I didn't think that much. We were more worried about deflation, right? And we were looking at this, but it reminds me of there was a lot of criticism, I think, among many, when at this place in 2019, another dose of QE was announced, very much on the back of a 5-year. And I shared that view. That's one indicator that starts to look. Of course, there's a risk of deflation. So it's a
principal matter. And to be fair to Charles Goodhart, who's of course a very an excellent economist, whom I admire quite a bit. I mean, he's of course he never said that inflation expectations don't matter, but he said there is a certain overemphasis of inflation expectations in the discussion. And I actually heard that you share that view. And the other point he made is that we have to think about the causality, and that was a point that you also made. So normally I wanted to have a round now among the 4 of you, but I must admit that you all took so much time for your presentations that I think we cannot do that, otherwise we won't have questions from the floor. So I would like to move directly to the floor. I will collect maybe 3 questions. Oh my God, I have many questions. So okay, so let's start on that side. So Markus, please.
Thank you. Very nice panel, nice discussion. I have 3 questions. The first one is to Ricardo. If you think about de-anchoring, would you look at the headline or the core inflation index? And in particular, if households de-anchor, do they care not more about the headline than about the core? So, and often when we do monetary policy, we focus too much on the core and too little on the anchoring. Another question to Loretta. In terms of what wasn't emphasized so much is communication. How much of the communication should be targeting the market, the financial markets, and how much the households and how much the firms? Are we overemphasizing how much we talk to the markets and too little to the real economy? And then I would like to ask Ulrike, of course, within the euro area, we have, of course, different countries which had different experiences before the euro on inflation experiences. Have you looked at some within the euro area that people who have experienced high inflation before the euro came into place, and they also have high inflation expectations now, and hence they're more hawkish at this stage? Thanks.
Thank you very much. So let me take one from the middle. So James, please.
Jim Bullard, St. Louis Fed. So I think there was emphasis on the panel about discounting past observations, and I think that's certainly the case when you get practical about measuring inflation. So does the panel think that inflation expectations are at more risk of becoming unmoored in the current environment where you're starting to discount some of the very stable data that we had in the pre-pandemic era and putting more weight on the very recent outcomes, and that seems like that could be very risky for both the US and for the ECB.
Thank you very much. Okay, so Beat, please.
Thank you very much. One question in terms of particularly household inflation expectations and the policy response to a potential the anchoring or too high inflation, because does it matter? You know, a lot of central banks often take confidence, or the ECB in particular, to say, well, market pricing has moved, so there is obviously a tightening of financial conditions, and so we are already on a good way. But the question is, do households, do regular people really notice that if the actual policy rate is still negative in this case and might be negative in September, still until September if we take the current communication? And doesn't it mean that, for example, for floating rate mortgages, they're still extremely low? So does it really have an impact on these expectations? I guess on the Fed side, you could argue that the most prominent mortgages, 30 years, they are now around 6%. So obviously there has been a very big change, and so there it matters. But on the euro area, I'm not so sure. Thank you.
Thank you very much. So actually, I will take 3 other questions. So Michala, Silvia, Vitor.
So thank you very much, and thank you for 3 very interesting presentations. It seems to me that fiscal policy is also a key factor in what's happening today in the policy mix. And I wonder, when we think about inflation expectations, to what extent people's expectations on the fiscal policy stance would be playing in. It seems to me that, especially with the pandemic, the previous expectation on fiscal discipline has really changed in the minds of households. So I was wondering if this is something that you have thought about and how it feeds in. Thank you.
So we need the mic here, so one of you first.
Hi, thank you very much for this very interesting panel. My question to Ricardo on linking behavior to expectations, and I would say also vice versa. One on wage formation. I think we have some data that show that workers are getting higher wage increases for these current years, but they accept lower wage increases for year 2 or year 3, multi-year negotiations. What do you make of that? And second, when you look at household surveys from the European Commission, they all expect prices to keep increasing in 12 months horizon, but you have not seen any increase in consumption. 7M has shown the consumption data, even the high frequency, are disappointing, and on expectations of future consumption, they're also lower. So how would you link these to your model? Thanks.
Can you pass on the mic to Vitor, please?
Well, thank you. I am on the side of Charles Goodhart in showing some skepticism about the importance of expectations. And I would like to ask Ricardo and Loretta if they can clarify to us how exactly they think that expectations and expectations of whom really influence price formation in our economies. One stylized fact that the economy is dominated by imperfect competition markets with pricing power by firms. Also, many surveys show that more than 50% of the firms use a markup model to take decisions on prices. And so how exactly are the mechanisms that lead, say, from forecasts of expectation of inflation by households and the end price formation? One thing is clear, the expectation of households about inflation affect their behavior on consumption and savings and whatnot, but not necessarily on price formation. Because when Phelps and Friedman introduced expectations in the Phillips curve, they were thinking about the importance of collective wage negotiations between trade unions and firms, and expectations and information on both sides and all of that. That has, over decades, disappeared in advanced economies. Trade unions wane, even in Germany. Only 15% of the workforce belongs to unions currently. After the late 60s, you don't find examples of the importance of those wage negotiations in advanced economies. So how exactly those there? Just, I would like to draw attention to a paper by the ECB of last year, 2006 and 4, the working paper that asks, do inflation expectations improve forecasts of inflation, which is a different question. It's not about how expectations impact the formation of prices, but about if they help to predict inflation. And very briefly, they conclude the following. They use 18 models, reduced forms, and 3 Bayesian VARs to predict inflation. And they conclude, first, that expectations coming from surveys, either of households and firms, do not contribute to improve the forecast of inflation. And also, what comes from extracting from financial markets also doesn't improve. Only what comes from the survey of professional forecasters and consensus improve by about 10% in what regards forecasts of headline inflation and up to 20% in what regards forecasts of core inflation. So that introduces some skepticism from this angle, which is different from the first I asked about, this angle of expectations contribution to improve forecasts of inflation. Thank you.
Thank you very much. So maybe you can try to be very concise, because I have more questions in the audience and I would like to give everybody the floor who wanted to have it. So we go in reverse order maybe. So Erik, whatever you want to respond to.
Right. Maybe Beat's point, there was no specific otherwise, I think, but it's on consumers. I think this is personally, I don't know of any, I think Vitor now said it actually, there is no real research that gives credit to the importance of it. But you said something else that triggered my mind, which is that the ECB has actually already implemented a very significant monetary tighten or withdrawal of stimulus, right, via forward guidance, so the market had repriced dramatically. Since you were so kind to refer to my beloved Berlin, on Saturday I was at my Hoffest in Berlin, and 3 of my neighbors, when they heard I was going to Sintra, and I had to explain what Sintra was, were telling me about their reset of their mortgages, which was close to a doubling of their monthly payment, right? And 2 of them were small business people, right? So it's hitting already, right? So it's very, and this is in Germany even. So you've done very well in getting going, but it's it's felt. So and that was on household, small business, but think of them as households.
Thank you.
Details upon request.
Ulrike?
Yeah, just 2 or 3 quick things. First, on Marcus's question, there is indeed research on the different inflation experiences across different countries by Ehrman and others, which shows that is still impacting inflation expectations today and explains some of the cross-country differences. We've also shown that this in turn shapes housing markets. So people who have, I'm not Ulrich Binzahl, but fine. People who have experienced high inflation will look for hedges, and one of the hedges is kind of fixed rate mortgages, and that those past experiences strongly affect the rate of people living in their own home. This then links to some of the questions about, market might move, but will households, will the regular consumer be affected? I think the third question. And indeed, that would be my perception. Exactly as you stated, like what mortgage rate you are experiencing, what you're seeing in the prices is, I think, what will be in the minds of consumers. And that will persist for a long time, which briefly links to Sylvia's remark that consumption spending continues to be kind of disappointing. That's exactly what this insight of really long-lasting effects of past experiences would predict. We also saw it after the Great Recession in the US and other countries.
Thank you, Ulrike. Loretta?
Yeah, so just a couple of things. So Marcus, it's communications not only to the market matter. So the communications, it's very important to talk to households so they understand what the policy goals are and what we're trying to do with policy. So I agree totally with you that we not just focus on communicating with market participants, but also communicating with households and business people who are the price setters. Jim, the models that I've seen, the forecasting models of inflation, there's different measures of, do you have forward-looking expectations or backward-looking? All the estimates I've seen is there's much less weight on the backward-looking than the forward-looking. So I think your point is right, that in this environment, and this I think fits with Ulrike's results is that the current situation has a higher potential of destabilizing inflation expectations. And Vitor, your question about forecasting models, I mean, all research coming out of Cleveland says it does reduce the forecast errors on inflation if you look at inflation expectations. Yeah, but I mean, it's still like a benefit to that. In terms of the actual mechanism, right, again, the research doesn't really tell you what the direction of causality is. When you talk to business people, one mechanism is they do think about markups because they're experiencing higher costs themselves, but how much they mark up when you talk to them depends on what they think inflation is going to be doing going forward. So how much do they think the Fed's going to get back down to 2%? And that's informing how they're setting their prices. Now, whether that's sustainable in a perfectly competitive market is debatable, but in the moment, that's kind of what they're doing. Yeah. No. Right.
So, Ricardo.
Okay, a few points. First, is it hard to measure expectations? Of course it is. That was my very first point. By the way, it's pretty hard to measure output gaps, in case you haven't noticed. And doesn't mean that you don't pay attention to those when you're setting monetary policy. And if you're worried about picking numbers, boy, look what happened with overreacting to numbers on inflation measures over the last few months, Eric, where people are looking at different measures, you go up for some or more. So of course it's hard, and I hope that I made that very clear in my presentation. It is absolutely hard. And note, that's why also I even took numbers out of the axis to say, and always said maybe it's between 2 and 3.5, 3 and 4. So absolutely could not agree more. You do not over-respond to 0.3% changes in expectations. 2, though, what is this? What was this? Sorry, I don't know what this is. Second, though, should you not respond again to some of those measures? Again, as I showed, if markets' expectations, they move all the time. I would never respond to them. There are a lot of noise, and this is why, as I try to emphasize, these expectations are useful in turning points. They're useful when you see very large deviations, when you see them all moving, as has happened, the professionals of the delay, but also happening. And so the point was that it's in turning points, not in a setting of policy month to month that one looks at expectations. And that was very much the point I try to make. Third, turning to professionals. The professionals, as Vitor reminded, and absolutely is correct, professionals are very useful in forecasting. They add to forecasting power in normal times, but in spotting turning points, they, in the 3 or 4 examples we have in history, they got it wrong in the same way that the type of models of central banks in turning points often get it wrong because they're very biased on past data. That is the point I made, not that professionals are never worthwhile. I didn't say that. I said in turning points, the professionals' expectations tend not to get it right. Inflation risk premium. If your model is telling you that inflation risk premium changed 120 basis points, at the same time where we see nothing comparable in equity risk premium or bond risk premium, there's something wrong with your model inflation risk premium. Not that the data is uninformative and it's all noise. And that's a point that I made very, very quickly also in my talk. I think the models that we use to measure inflation risk premium are just throwing a lot of stuff out, and Loretta also mentioned it as well. Fifth, and importantly, really to agree with the way Loretta put it, and to emphasize how consistent it is with what I try to do with my table, Loretta noted risk management. My table of shocks and how they work, that's the typical risk management table. And the point there is, maybe you want to ignore it if you focus on the first row, but if you take a risk management, all the other ones point in a certain direction, that if you want to interpret this somewhat as a danger, then you want to respond. And luckily in this time, all of them were actually pointing in very much a similar direction. And then briefly, 2 more points. On Vitor, on the expectations of firms, I don't have data on expectations of firms in the euro area, but when we look at expectations of firms, and I think it was Ulrika who mentioned in her talk, we have not found, and again, preliminary research, we meaning the community of researchers, not myself individually, have not found that firms are actually all that different from households. They seem to move with the households, or if anything more with the professionals. So not having data, I'm going to look at the households and say it's closer to those of the professionals. That's what the papers by Gornichenko and many others have found so far, subject to the noise of that. How does the price formation work? Just like I already told you, but I'd even go a little further back. Just like Friedrich Hayek or Ken Arrow taught us, in general equilibrium, you respond sometimes to the observations of what you see, not necessarily to some expectation of how the equilibrium works. Firms respond because all of a sudden they're facing higher wages, all of a sudden they're facing less demand for their product or more demand for their goods. That's what they're responding to. Why did we have higher wages? Why do we have more or less demand? Because some households start expecting higher inflation. But the channels are there in general equilibrium. It's basically the fact that it's not that you say I'm responding exactly to someone's expectation. It's the fact that those in affecting shopping behavior, like Ulrike was noting, in affecting the way in which you choose a mortgage, this or that, that is going to affect relative demands. And as a business, all you have to do, as Hayek and Arrow's insight, all I have to do is look at how many people are working through my shop, what is happening to my costs, I'm adjusting my prices, and lo and behold, what's happening to expectations in households, animal spirits, as I said, even if so, are being reflected in what I do, and that's why I even covered the animal spirits. And finally, on Sylvia, on the future expectations. Of course, also when looking at expectations, one has to, I think, take into account what we learned in the previous paper by Shebnem and others, which is there is a supply shock going on, and therefore, given a supply shock, expecting both high inflation and expecting to spend less in the future is, if anything, a sign of some rationality of these consumers. Which is not to say that the counterfactual, which is if you had expected no higher inflation, would you have consumed a little more or a little less? And finally, on the wages, which you also mentioned, of course, it is consistent and possible, not to mention something to take into account, that as households are forming expectations of how life is going to be hard given the supply shocks, how unemployment may raise, and as prices may come, households may choose is the wrong word. We may end up with wages rising less than inflation. In many ways, that fall in real wages may contribute to having less of unemployment next year. That is not inconsistent with being afraid of inflation, with monetary policy having to be tighter, as a response to those expectations. Meaning, it is not because we don't see wages going up by 8% next year that shows, aha, those expectations of 8% were not merited. No, because we have the supply shocks that should lead people to be expecting a real wage fall, as I would expect. The question, of course, is whether it's very large or very small. Sorry.
Thank you very much. So we started a couple of minutes late, so I will have 2 more questions. I think John was very early. And, okay, Sasan. But please, in the questions and in the answers, try to be as concise as possible.
Just a quick comment on Ricardo's model, which assumes that real rates always have a negative effect on consumption. And that isn't, in fact, true. I mean, theory says it's ambiguous. And in fact, in the euro area, German households take liquid assets minus debt to income. German households have the biggest ratio of net liquid assets of major economies. And negative real rates have a very negative effect on the expenditure of these households, particularly older people with saving deposits whose deposits are vanishing in front of their eyes or falling in value in front of their eyes. So the expenditure effect for Germany on our aggregate data actually suggests there's a small perverse effect of real rates, other things being equal, on German consumption.
Then over there, please.
Thank you very much. Sasan Garamani, SGH Macro Advisors. I'd like to pick up on some of the strands, including Jim's comment here, a question, and ask about non-linearity. The economics profession tends to try to smooth out and look at sort of averages. I'll keep it brief and simple. Does volatility matter, especially in an environment like this, just volatility per se, especially in the instance where, we have current expectations forming a lot of our actual behavior now, and I hear talk about, sort of looking at the 5-year and sort of settling in on an average of 8, 5, 4, whatever to 3.5%, 4%, but isn't there a lot more dispersion and risk here that this sort of taking signals from this could be dramatically wrong at this point in time? Thank you very much.
Thank you very much. So not everybody has to respond, so who wants to? Please go ahead.
Oh, volatility matters hugely, and that's why in those measures I told those algorithms try to really downweight, depending on variance, skewness, as well as volatility of the series, what they are. And absolutely, you do not want to respond to any day-to-day, week-to-week, even month-to-month measure in those. Again, I try to be very careful. There's a change here, and then I kept on dismissing any movements up and down, month-to-month, of my own estimates, because I don't think you should in any way respond to those. And on the nonlinearity, turning points, that's precisely the point I've been trying to drill in, which is these data are useful to show you there's a switch here. There's a nonlinearity in terms of some regime changes. On the, just on the real rate perverse effect, John, I mean, I wrote down, it wasn't my model, it was just the standard New Keynesian model that, which I thought was good to illustrate my models, to illustrate the points that I was trying to make. On whether it's perverse, then I guess ECB then changing nominal interest rate is going to have a perverse effect on Germany as well, no? Because the nominal interest rate, the real rates that you said is nominal interest rate minus effective inflation. If effective inflation is perverse, so is the nominal interest rate perverse. So maybe, so that's, I think, more to the monetary experts on whether raising or lowering nominal interest rates has perverse effects in Germany or not.
Thank you very much. Anyone else wants to?
Can I add something? So just to be clear, data dependency, at least in my conception of what we mean by data dependence, doesn't mean you react to every data point. You're inferring what's going on underneath in the economy and the things that you should care about. Right? So that Michigan survey wasn't the precipitating event of raising interest rates at the last meeting. It was really based on looking at the trends in the data and whether we were seeing any easing off of that inflation at all. And we take all the data into account, at least when I'm setting my own policy views. It's based on not just one data point. It's important to know that.
All right, thank you very much. So I think we should come to an end of a fascinating session. So let me just try to wrap up a bit. So I think we all agree that inflation expectations matter, but that we should not overemphasize them. We should certainly look at different measures, taking into account the weaknesses and strength of the different measures. The dynamics of different measures can be quite different. So market-based measures may be overly influenced by current oil prices, while the household expectations may be very much influenced by the lifetime inflation experience. We are still debating on whether professional forecasts are useless or not. I think we haven't made up our mind yet. So there is a lot of heterogeneity across different. I think it's also clear that the anchoring of inflation expectations poses a threat to central bank credibility, and I think the measures that Ricardo has developed on that are extremely useful. Our commitment to price stability certainly matters. Communication matters, and I had hoped that Ulrike would mention it, but she was actually suggesting that you, President, would start to sing your monetary policy statement next time to get to the emotions of our audience. Was a bit exaggerating, but so finally, once inflation expectations are de-anchored, it's very hard to re-anchor them again, because part of the inflation experience may actually be built into the brain, and I think this is something we should take very seriously. But with that, I wish you all a very nice lunch. Thanks to our excellent panel participants for a fantastic discussion. Thank you.
So thank you, Isabel, for doing such an excellent job of chairing that session, and to all of our panelists. I'd like to say a brief word about Charles Goodhart, if I may. I recall Charles once saying that the role of the monetary economist is akin to that of the fool in King Lear, there to tell uncomfortable truths to those in power. True or not, I think this discussion has shown how valuable Charles's provocations last year were. He's forced us to think carefully about the gaps between theory and practice, about the importance of the price of groceries and gas, about who remembers and who pays. And in so doing, he's provided a vital service to the policymakers here with us today. We'll now break for lunch. Please join us again at 2 p.m. sharp. Thank you. Inflation is back. And for the first time since before the 2008 financial crisis, the European Central Bank, the Federal Reserve, and the Bank of England, along with a host of other central banks, are all tightening monetary policy. But the threats to growth are immense too. Policymakers face a delicate balancing act between stamping out inflation and avoiding a recession. Ladies and gentlemen, for traversing this narrow path, Francine Lacroix, editor-at-large at Bloomberg, will be moderating the session. Francine, the floor is yours.
Claire, thank you so much. Now, we're here at the ECB Forum on central banking, and every year it's very clear that Sintra really dominates the attention of investors, but not every year is like this one. Now, for one, it's not, I'm told, quite as windy as it was yesterday, but that, of course, is not what makes this year so special and so unique. We're entering a new chapter for monetary policy, a divergence for almost 15 years of policy experimentation in an age really defined by stubbornly low inflation. Now, this year that has changed. As Claire was saying, our policy panel needs a little introduction, but I'm going to do it anyway. Jerome Powell is the chair of the US Federal Reserve, Andrew Bailey, governor of the Bank of England, Agustin Carstens governed the Bank of Mexico before becoming general manager of the Bank for International Settlements, and of course our host, the president of the ECB, Christine Lagarde. Now, just a reminder, between them, these institutions hold nearly $20 trillion worth of assets on their balance sheet, and they've, of course, maintained ultra-low, even negative interest rates for the better part of a decade with little disruption. They now have the unenviable position of presiding over the great unwinding of policy that may have permanently changed the architecture of global markets. So thank you all for joining us. We're going to have, I'm sure, a robust discussion over the next 90 minutes. Mr. Carstens, let me start with you as a central bank of central banks. You know, central banks in general have faced really a succession of crises over the past years, but also some of the structural factors, such as the green transition, digitalization, and increased onshoring. So how different will the future of inflation be from now on? How different will it be from the last decade?
Well, I mean, a very important change that has taken place in the last, I would say, 2 decades, or even more. If, for example, we compare this period of inflation with the 70s, is that we have much stronger institutional monetary frameworks and institutional framework for central banks. And I think they're far better positioned to combat inflation. If we go back 70s, and 70s have become a natural reference, we were at the time where, for example, the Bretton Woods was failing. You don't have more, I would say, instability in a system when you are, for example, revising your exchange rate regimes. And that is not happening today. I think that the period of disinflation there established very, very strong basis to create new and more nimble, more agile, better prepared central banks. And I think, for example, the design of the ECB, our host here today, in a way incorporated many of those learnings. So, I mean, when you are in charge of combating inflation, what you need to be able to anticipate is that sometimes you will be surprised, because there are many elements that affect inflation and that they are not directly under your control. And I think to a large extent, this is what we are seeing today. And I see a very, very strong ability of all central banks to analyze, to incorporate that information, and to react. For me, if you look very careful what is going on right now, in the last 2 years, we have seen dramatic changes in the environment. We went from having a situation where depression was felt, was feared, deflation was coming, to a very quick rebound with the vaccination and so on and so forth. And we moved tremendously quickly from an environment of fearing deflation to fearing inflation. And that has been compounded by the Russian crisis. I have to say, monetary policy, as nimble as it can be, cannot respond with that celerity. So I think that the knowledge of the new form of inflation is being learned and is being responded. So I'm very positive that this institutional framework and strength of central banks today will take us to the goal where we want to be relatively soon.
Chair Powell, do you agree? I mean, when you look at complexity and uncertainty, has it always been this way, but we forget about it? Or is this really a new frontier?
So I agree with everything Augustine said about institutional progress. But I would add this. We've lived through a period of disinflationary forces around the world. This is globalization, aging demographics, low productivity, technology enabling all of that. And that was, so we've been in that world where inflation was really not a problem in most of the advanced economies most of the time. Since the pandemic, we've been living in a world where the economy is being driven by very different forces, and we know that. What we don't know is whether we'll be going back to something that looks more like, or a little bit like, what we had before. We suspect that it'll be kind of a blend, but in the meantime, we've had a series of supply shocks. We've had very high inflation now across the world, certainly through all the advanced economies, and we're, to Augustine's point, we're learning to deal with it. Our job is to find price stability and maximum employment, in the case of the Fed, in this new economy with these new forces. And it is a very different exercise than the one that we've had for the last 25 years. Nonetheless, the goals are the same.
Yeah, so I don't know whether, Madame Lagarde, after this volatility, do we go back to something that resembles the last 10 years, or is it, something else completely?
I also agree with most of the points that Augustine made, and we don't have to agree between us because we always do. But I don't think that we're going to go back to that environment of low inflation. And I think that there are forces that have been unleashed as a result of the pandemic, as a result of this massive geopolitical shock that we are facing now, that are going to change the picture and the landscape within which we operate. If I look at our euro area, for instance, we have record low unemployment. We have inflation expectations, however unprecise and with the pinch of salt that was discussed at the last panel, which was excellent, we have inflation expectations that are much, much higher than they were. That's for the internal matters. But if you look at the rest of the world, a lot of the movements that we've experienced in the last 20 years was predicated on globalization, on the breaking down of supply chains, on the reduction of cost, on the just on time. That has changed and will probably change continuously towards a system that we are not certain about at this point in time, which is much debated. Some would argue that globalization will continue in a different format. Some would argue that the place where you manufacture, the place from which you provide services is going to be determined by different factors than just cost. It will be about cost as usual, but it's also going to be about where do I locate my services, where do I employ people, where do I reduce my costs, and are those areas, geographical as well as political, actually foes or friends? And do I have some predictability about the future of my production or the providing of my services? And the third factor that is going to change the scene, from my vantage point, is the way in which we produce. And I think that the shift that we're observing in Europe, certainly, towards green transition is also going to change dramatically the way in which we operate. And all those forces are going to produce inflation, deflationary impact that are still to be measured, but in the short run, I have some ideas as to where it's heading.
And we'll get back to those ideas shortly. Governor Bailey, do you see this as a sea change for the longer term future?
Yeah, yes, I do. I mean, I think first of all we have to say that unquestionably, of course, our task is to return to low inflation. But I think, and we see this, every day, that in fulfilling that task, we're observing certainly, what can turn out to be structural change, and some of it, I think, I would say, is already getting there. So, I think COVID is leaving a structural legacy on labour markets and the way they behave, which we're already beginning to see. I mean, I think sadly the European security situation has changed. I mean, we hope it obviously doesn't persist, but it has changed, and that's affecting, as Christine was saying, that's affecting supply chains. It's affecting the resilience of the whole supply system. And you mentioned climate change, Francine. I mean, I always say that this is not, because some people sometimes say this is not some sort of dilettante activity by central banks. The reason that we're not in the lead on it, clearly, but the reason we have to take it seriously is because it is affecting our world. And actually, it will get worse. I mean, that's the sad fact of life. And we have to, in a sense, understand that and understand what effects it will have and how we respond to it. So these structural changes, are very important in our landscape.
So, Chair Powell, as these complexities or as these sands are shifting, is slower growth, much slower growth, an inevitable trade-off on trying to deal with inflation?
So I would say that if what we see, for example, is the redivision of the world into competing geopolitical and economic camps and a reversal of globalization, that certainly sounds like lower productivity and lower growth. And in many parts of this side of that, you see aging demographics, so a shrinking workforce, and you see economies that are growing more slowly and whose workforces are not expanding. So that's certainly a possible outcome, and I think probably to some extent a likely outcome.
And in the shorter term, can the economy, can the U.S. economy actually deal with, a possible onslaught of interest rate hikes?
So the U.S. economy is actually in pretty strong shape. So if you look back a year, the U.S. economy grew more than 5.5%. It was really the big reopening year. Mm-hmm. And so we had expected this year to be that growth would moderate to a more sustainable path. We also, of course, are raising interest rates, and the aim of that is to slow growth down so that supply will have a chance to catch up. We hope that growth can still remain positive. But if you look at the strength of the economy, households are in very strong financial shape. They've still got a lot of excess savings from forced saving from not being able to travel and things like that, and also from fiscal transfers. So households are overall, not every household, and not the ones at the lower end of the income spectrum, but overall in strong shape. The same thing is true of businesses. Very, very low rates of default and things like that. Lots of cash on the balance sheet. The labor market is tremendously strong, still averaging very, very high job growth per month. So overall, the U.S. economy is well positioned to withstand tighter monetary policy, we think.
But is it automatically a trade-off between fighting inflation or taking care of the economy, and how far are you willing to go with interest rate hikes?
So I guess I'd say it this way. Our aim is to have growth moderate. It's sort of a necessary adjustment that needs to happen, so that, again, supply can catch up. It could be supply of workers. It could be time for the supply chains to improve. So the sense of that is that if we can get, right now, supply and demand are really out of balance in many parts of the U.S. economy, labor market being a big example of that. We need to get them better in balance so that inflation can come down. And that's the aim of what we're doing. Now, we don't have precision tools. Obviously, monetary policy, famously a blunt tool. That is our aim, that is our intention. We think that there are pathways for us to achieve that, to achieve the path back to 2% inflation while still sustaining a strong labor market. We believe we can do that. That is our aim. Mm-hmm. There's no guarantee that we can do that. It's obviously something that's going to be quite challenging, and I would also say that the events of the last few months have made it significantly more challenging, thinking there particularly of the war in Ukraine, which has added tremendously to inflationary pressures around food and energy commodities and agricultural chemicals and industrial chemicals and things like that. So it's gotten harder, the pathways have gotten narrower. Nonetheless, that is our aim, and we believe that there are pathways to achieve that.
President Lagarde, can you talk to us about this fine balancing act for Europe and what that means?
Well, you know what I find extraordinary is that sort of 10, 15 minutes into this debate, we haven't really used the word energy. And certainly in this part of the world, the energy shock that we have suffered, are suffering, and probably will continue to suffer, has had a major impact. And I think this is not specific to Europe, but there is certainly a dependency of European countries, and the euro area is certainly a point in case, to external supply from foes. And that has had a major impact on prices. It is certainly a very driving force, a strong driving force of the inflation that we have experienced in the last few months. This has been, as you said, Jay, exacerbated by the war. And I think the proximity of Europe relative to the war scene has had probably a more significant impact on the price both of energy and of food, which are clearly very important components to take into account, including in inflation expectations, as was discussed earlier. But we also have, that end is a series of supply shocks that are hitting the European economy. But we also have this recovery that is very much underway, that is certainly driven by services because of the swing that we've observed from goods to services, and which is also supporting the economy. We have very low unemployment numbers, high employment participation. Some of it is more attributable to public service jobs than private sector, although that is also back to pre-pandemic moments. And we have a couple of other items, such as significant savings that are still to be used, hopefully, or not. And we have fiscal policy. And the fiscal policy that we are seeing at the moment is roughly in the range of 1% GDP. But we need to see how fiscal authorities move, where they move, and we certainly hope that they will move in a targeted, temporary way in order to make sure that they support the most vulnerable and not in a broad and discriminated fashion as we have unfortunately observed so far.
Why do you prefer actually the more gradual approach? So yesterday you reiterated 25 basis points
Gradual
hike.
for monetary policy?
For monetary policy.
Well, don't forget, I didn't say gradual full stop. I said gradual but optional. Yeah. And I think it's a combination of the two that actually matters for us. Moving gradually is certainly appropriate in times of very high uncertainty, but as the uncertainty will clear on various accounts, we will have to certainly be less gradual and give more weight to optionality. But we have both of them in combination at the moment, optionalities being also a very critical aspect of our determination.
Mr. Carson, I mean, you've been pretty vocal, actually, on what central banks should do. Do you think they need to cut faster?
Well, I mean, I think everyone should react according to their own circumstances. What is very satisfactory at this stage is that pretty much all central banks have starting address the issues. I mean, one way of dealing with it is through words, to recognizing you have a problem, to saying that you will address it, and pretty much all have already entered into the field of action. So central banks have been acting in consequence. I have to say the level of interest rates worldwide have adjusted. The level of interest rates, if you look them from the yield curves, they have been increasing quite substantially. What we can say is that global financial conditions have tightened substantially, because we don't have to, we shouldn't forget that this in a way has become a global phenomena. I mean, inflation around the world has been increasing. Now, each country, as Christine and Andrew and Jay has been saying, each one face different dynamics of inflation. I mean, in a way, I think what is very, very important is that in the realm of their own economies, what they should try to do is at some point prevent a full transition from a low inflation environment to a high inflation environment where this high inflation gets entrenched. And for that, basically, you need to prevent these vicious cycles to kick in. And pretty much all of them are addressing it. In these vicious cycles, labor markets are very important, and labor markets are very different across the world. Therefore, I think that there is no one recipe or no one remedy for all. But what I'm seeing is that pretty much all central banks have been addressing the issue in a forceful, determined way according to their own circumstances.
Mr. Carsten, does it mean that you would be in favor of front-loading hikes so that it's a powerful message maybe to people, for a lot of the citizens?
Well, let me give you a good example and to introduce a little bit of a different flavor here. I come from emerging markets, and if you see how emerging markets have been acting this time around compared to other periods of very high interest rate increases in advanced economies or the expectations of fast increases in interest rates, they have acted quite well, I mean, if you see, the more recent episode was the temper tantrum, where many emerging markets suffered dramatically with the expectation of higher interest rates. My own country, Mexico, several of our crises have been associated with rapid increases in US interest rates, but we have learned our lesson. And so what you see is emerging markets traditionally were the ones who would increase interest rates at the very end. Now they started very early on. And what you can see is that they have managed to keep their exchange rates quite stable. Traditionally, in emerging markets, exchange rates was a very important source of inflation. So now they're still facing the sources of inflation from the commodity shocks, from energy, from world aggregate demand, but not the ones that could have been inflicted by the movement in the exchange rate. So there you see that different central banks can act at a different pace. For them, it really was critical to act forcefully and very, 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 very early on in the game. But that's not the circumstances you see around. So I mean, I would say that each central bank is playing its own game because it's different circumstances.
Governor Bailey, does the guidance from the BOE on moving forcefully actually open the door for 50 basis points?
Well, I think the way I would frame that, it very much goes back to what the others have been saying. And as Christine was saying, I mean, we are being hit by a very large national real income shock, which is coming from outside. There is uncertainty around two parts of that in terms of monetary policy. One is, of course, the eventual scale of it, because it's unfortunately still evolving. Secondly, the impact of it, precisely how it passes through into the economy and what the effects of it are. But the scale of the shock is very substantial, and in and of itself, it will have an effect, a big effect, because it will reduce domestic demand, and it will pass through into the labour market, and it will pass through into inflation. Monetary policy has, of course, a very important role to play because it will act alongside that shock. And it's very important, as we've said, and this is where we come to the language that we use, that it, of course, is there also to tackle the second round effects as they come through price setting and wage setting. So the message that we gave and was in the language of our last meeting, as you rightly said, was that if we see greater persistence of inflation, that's second round effects, then we will act more forcefully. And we will have to act more forcefully. Now, in terms of your precise question, what does that mean? Well, of course, I'm not going to say what it means at our next meeting, because our next meeting is still a month away. A lot will happen between then. What I would say to you is that, of course, it leaves options on the table, and that's very deliberate, very deliberate. I mean, I want people to take a message away from that. It's quite clear that as we respond to this shock, we want to have those options on the table for precisely the reason that Agustin has just said. There will be circumstances in which we will have to do more. We're not there yet in terms of the next meeting. We're still a month away, but that's on the table. But you shouldn't assume it's the only thing on the table. That's the key point.
But Governor, for you personally, would you be leaning towards 50 basis points?
No, because I'm going to see what happens in the next month. No. I'm afraid one thing that is omnipresent in our system is that we make policy meeting by meeting, and there's always another meeting. If you can only guarantee one thing in monetary policy, it is that there's another meeting.
Yeah. Is it actually annoying that markets or reporters always try and understand, some of this very personal thinking on interpretation, for example? Chair Jay Powell, I tried my luck with Governor Bailey, but how do we, how should we be thinking about this? Like, is it, markets or reporters trying to really always get just that nugget piece of news?
Yes, well, certainly there's a lot of that going on, I would say. But no, I guess I would, to put a more constructive spin on it, the markets and market participants are always wondering what we're going to do. They're always wondering what we're thinking. And when market moves happen, that's really a constructive thing. It's never going to be exactly what we're thinking, but nonetheless, it's constructive that the market, in effect, is doing your work for you if it correctly understands your reaction function. So that's maybe a more constructive way to.
And is it correctly understanding what you're saying right now?
So I would say, by and large, I think over since last fall when we pivoted to raise rates and get where we are now, since then markets have been pretty well aligned. I wouldn't bless any particular day, for example, but pretty well aligned with where we're going. And right now, the market pricing is pretty close to where the summary of economic projections from, 2 weeks ago was. So my colleagues and I wrote down numbers for the end of this year for our policy rate between 3 and 3.5%, and markets are broadly right in that space somewhere. And then for next year, between 3.5 and 4%. So broadly speaking, I think it's working. And everything we say in terms of forward guidance, to your point, is always going to be conditional on the things that happen between now, when you give the guidance, and when the actual event happens. And sometimes markets can forget about the conditionality part.
But is there a problem actually with forward guidance in this kind of environment because it gets priced in straight away? So it feels sometimes like markets lead and central banks follow because of the forward guidance.
Yeah, it doesn't really feel that way at all from where I'm sitting. It feels quite the opposite. And no, as I said, I think people will look back on this period and say that we were able to have financial conditions tighten quite substantially, and we've only had 3 meetings at which we raised rates. Nonetheless, the forward rate curve is pricing in, a rate path that looks a whole lot like the summary of economic projections that my colleagues and I submitted in June. So that's a good thing. That's the market understanding and finding credible what we're writing down. Now, of course, it's all highly conditional, but nonetheless, I'd say that's a positive thing.
Yeah. Do you agree, Madame Lagarde? Is it a positive?
Yeah, I would agree. From our vantage point, we are on a normalization path. We have signaled that very clearly. We've started that back in December. And, the key assessment is the assessment of the medium-term outlook. The variables that we look at, the data that we look at, I think everyone is aware of that. And most people operate on the basis of the same data, the same information. And I think that our reaction function is what matters. And as long as that is understood, the fact that we are on this normalization path, that we are gradual but optional, that we're going to be data dependent. We've indicated very clearly what's likely to happen in July. Yes. What's likely to happen in September? Yes. And, in the path that we are on, I think that markets have full understanding and appreciation of what we are doing, how we're doing it, and then the level of uncertainty as it clears will probably help us towards this optionality that I was describing earlier on.
Governor Bale, do you agree actually with the market function so far? Have they broadly understood what the central bank's trying to do?
Yes, I think they have. I think the tricky thing that you see, certainly I would say we see, is that we can obviously see direct market pricing. We can have an implied market curve which prices in what we're going to do. We also, as you probably know, and we just started doing this recently, publish a market survey at the same time as the meetings, and that actually shows a lower path of rates. So we spend quite a bit of time understanding the difference between those two. I don't think it's actually hard to explain, because I think the underlying reason is that the market curve prices in the risk, and the risk is on the upside, and I would agree with that. So whereas the survey is a straightforward point number, the curve has got the risk in it. So I think for me the best way to look at that difference is the risk. But that is a risk in that sense. And it's important to see that that perspective.
Mr. Yes, absolutely.
Not to get ahead of ourselves or to have to become big-headed about it, but there's a point that was made in a previous panel, which we all agreed over lunch, which is that it's not a science what we're doing. There's an element of art, I don't know whether you characterize it as art or not, but it is not just driven by sciences, and we know that models have had their shortfalls, particularly turning points. So there is also that element that is sort of privy to the deliberations that we have in our various governing councils and FOMCs and what have you.
Yeah. Yes.
Could I just add, we're talking a lot about markets and how we react to markets. Actually, to Christine's point, the way we're thinking about it is what policy setting do we need to put down to achieve the real economy goals that we're working on. That's what we're not thinking, wow, let's try to match up with the markets. We're thinking, what's the right policy based on our, the incoming data and the evolving outlook and all those things that will get us to 2% inflation while ideally keeping the labor market strong. So it's really, we're talking so much about markets, I wouldn't want people to think that that's actually what we're aiming for.
We still have an hour on the panel, so we have time. Is there a piece of the, I mean, do you worry about yield curve inversion though? Is there a piece of that makes you worry, or do you just,
So I would say this, we monitor a broad range of financial conditions. Honestly, the shape of the yield curve is not a top line worry for right now. Our focus is very intensely on setting policy in order to get inflation down to 2%. That's what we're working on. We understand that that's our primary focus right now. The labor market, of course, is extremely tight in the United States. So so our focus is getting inflation under control. And it's very important that people understand how committed we are to doing that. And that again, that's what we're thinking about.
Yeah, and I want to go back to the real economy and inflation in a second. But Mr. Carstens, what do you make of some of the what we've seen in market volatility? Is it just a readjustment? Is it a misunderstanding? Is there something that could turn uglier?
Well, markets are responding also to the circumstances. I think as policymakers, to some extent, have been surprised because there has been news that really are news and that were very difficult to anticipate. Markets are doing the same. And we have to, and you know this very well, markets are turning around very big positions. They're adjusting their portfolios. We are talking about a circumstance where for very, very long period of time, we had tailwinds in the bond markets. That we had very low and falling real rates of interest, falling nominal interest rates. So trading bonds was relatively simple. We had very big expectations for earnings into the future, a lot of interest in different sectors of the economy. Therefore, it was easy sailing for quite some time. But the world has changed. The world that investors are facing and the world that we are facing. And central banks need to do their work, not as an objective in itself, but as all these central bankers have been saying, to fix a problem, which is inflation, and then continue with a much better world moving forward. So there are certain circumstances in markets where frictions are bigger. Trading conditions are not always the same. I mean, you get circumstances of crowded trades because at some point the same type of investors are trying to do the same operation and liquidity is not necessarily there. Something that for me has been very positive is that central banks, the leading central banks, have been able to implement their money policy adjustments without really generating such big, any sort of market disruptions. Markets have been performing well, liquidity is there, market making is going forward. Yes, there has been some disruptions. I'm not talking about the cyber world, that's another fish, or how do you say it, another kettle of fish. But I think that the markets have been working really well. And yes, behind the actions of central bank, there is always the concern that markets should be working adequately, because you don't want to have financial instability. At the same time, you need markets working well for the transmission of monetary policy. And so far, I would say so good.
Yeah. But at what point, and I think that maybe the last point on markets is how much do central banks need to deal with markets, Mr. Carstens, to see, to I guess, impact the real economy?
That's for you.
Yeah.
How much do we deal with them? Oh, sorry.
Yeah, I mean, how much do you need to focus on markets to make sure that also the real economy is quite strong?
Well, I mean, we spend a lot of time analyzing markets, and all of that is fed into what impact those changes have on the inflation outlook. I mean, that's why we do it. With the second objective, as Agustin rightly says, of course, about market stability. Because after all, we've also got financial stability obligations and responsibilities. I mean, I think if I go back to the panel this morning very briefly, I think the point was rightly made that it's turning points that are the hardest often to read, and it's not just for us, it's for markets as well. And I think certainly when I look at the UK economy at the moment, it's very clear that the economy is now starting to slow. We are at something of a turning point in that respect. And I think the fact that markets are having to take that on board, and that the data can be quite choppy at that sort of point in time, is reflected in some of the short-run movements in markets. Now, I do think one of the essential things for central banks is to look through that short run. Yeah. We have to extract the information and then look through it, because obviously our objectives are much further forward in that sense, in terms of low inflation and returning to target. But in terms of taking the information out of markets, yeah, it's a very important activity for us.
Chair Powell, Paul Krugman, I think on Friday, said that the number one risk to the US economy is that the Fed could overdo it because inflation could come down as quickly as it went up. Is that really possible?
Well, we'd certainly welcome inflation coming down more quickly than expected, and we would take that into account in our policy. So look, as I mentioned earlier, we're very strongly committed to using our tools to get inflation to come down. The way to do that is to slow down growth, ideally keep it positive, and as I mentioned, supply and demand get back into balance. So that's what we're trying to accomplish. Is there a risk that we would go too far? Certainly there's a risk. But I wouldn't agree that it's the biggest risk to the economy. I think that, the bigger mistake to make, let's put it that way, would be to fail to restore price stability. And it's what Agustin was speaking to earlier, a low inflation environment or regime is what we've had. And that is one in which inflation is low and no one pays any attention to inflation, and that's called rational inattention, because it doesn't matter. When there's a big inflation spike, if it's going to go away, we would ignore it and sort of play through it, because it'll go away and it won't affect people's understanding. But to the extent there are a series of shocks, it does become rational for people to pay more and more attention. And I think the clock is kind of running on, how long will you remain in a low inflation regime where most of the changes in inflation are actually idiosyncratic as opposed to broadly across the macroeconomy. So the risk is that because of a multiplicity of shocks, you start to transition into a higher inflation regime. And our job is literally to prevent that from happening. And we will prevent that from happening. We will not allow a transition from a low inflation environment into a high inflation environment.
Is there a point where actually inflation expectations get de-anchored? And is that...
That's another way of saying it or thinking about it. It's the same thing, same idea. And the thing is, you never really know. There's no way to know in real time. We all study inflation expectations very carefully. And if you look across the broad scope of short, medium, and long-term expectation, you'd still say that we have credibility, that they're well anchored. But there's a clock running here where we have high inflation running now for more than a year. And no one should assume, it would be bad risk management to just assume that those longer-term inflation expectations will remain anchored indefinitely in the face of persistent high inflation. So we're not doing that. As a risk management matter, we're working very hard on the part that we can affect, which is the demand side. We can't affect the supply side, really. But we can affect the large parts of the US economy where there's surplus demand, and that's really our focus.
Is there a data point that you watch for to actually see whether there is a de-anchoring, or where do you see it first, basically, if it spirals?
The point is not to see it at all. We can't. Once we start seeing that, the cost of dealing with higher inflation goes up so much to the extent you find yourself in a higher inflation regime, that you just can't allow it to happen. So if you're starting to see serious de-anchoring of, and we're not, of longer term inflation expectations, then you're behind. And I think right now we're doing what we need to do, which is to move expeditiously and into restrictive territory fairly quickly. I think that's what we need to be doing so that we don't find ourselves in that situation.
President Lagarde, what's the situation like in Europe? And we had a pretty ugly CPI number from Spain this morning.
Yeah, numbers from Germany that are below what economists expected. So I think it's a question of waiting until the 1st of July when we have the consolidated number for the whole of the euro area, and we'll see, because we are data dependent. But just like Jay, our mission, our mandate, our job is to provide price stability, which we have defined as 2%. So we currently have inflation at forecast 6.8 for this year, moving down to 3.5 and 2.1 in 24. All of that is above target throughout the whole projection period, and we need to do what we have to do, which is to bring it back to 2%, and we shall do so. Now, of course, we are not exactly in the same situation as Augustin was saying. We need to look at our markets, we need to look at forces, we need to look at how the uncertainty that we have on the horizon is going to clear. And I think that in that respect, what happens on the energy front, what happens on the war front, unfortunately, what happens in relation to wage negotiations, and how inflation expectations continue to stay anchored as they have re-anchored, are some of the elements that we will be looking at very carefully in the job that we have to do to bring inflation back to 2% over the medium term. That's the same determination.
Yeah, Governor Bailey?
Well, I agree. I mean, like Christine, I am concerned about how the war front and the energy supply front is going to evolve. I think that is the major risk. I think, by the way, if I say, I mean, we had an inflation number out last week, and what I thought is that on the surface, it was pretty much in line with what we expected. Underneath the surface, there was a sign that we saw a shift in the makeup of inflation from the goods supply shock to the energy and food shock, which I would sort of characterize as the post-COVID supply chain shock, moving more sadly into the Russia-Ukraine world. And obviously, we watch that very, very, very carefully as we go through the year. As we've said in our last monetary policy report, unfortunately, there is going to be a further step up in UK inflation later this year, because that's a product of the way the energy price cap in domestic energy prices is set based on the data that we've observed over the last few months, and we have to take that into account. But as Christine and Jay have said, the key for us is to bring inflation back down to target, and that's what we will do.
I mean, hindsight is a beautiful thing, I know, and I also know the ECB published a paper and saying, what you got wrong on inflation. But going forward, Mr. Carstens, how do we need to look at inflation differently? So, for example, in the US, and I'll ask the same to Chair Powell, the stimulus, did we miscalculate the impact this would have on inflation?
Can I just say one thing? I think it's a very healthy exercise to actually assess why you were off the mark. And if all of you actually do the same exercise, you will probably realize, for most of you, that actually energy was vastly underestimated, and that bottlenecks were also expected to clear much faster than everybody had expected. I don't think the ECB is alone on that count. No. We are the first one to have acknowledged it publicly, but I think it's a good exercise.
No.
No, I mean, in the previous panel, for example, and if you look also into recent annual economic reports, you see that, for example, some very, very long-term held key components of the toolbox that we had to analyze inflation has not turned out to be so reliable. Like, for example, the traditional Phillips curve. That has been a workhorse for all of us. That, to some extent, kept, I would say, for some time, giving the indication that inflation could not rise that fast. We faced many limitations like that. I mean, I have to be very transparent. Last year, we tried to crank out some numbers of inflation, and we put them out there. And here's one of the researchers that did the job, and he had a hard time cranking up higher numbers as much as he tried. And we had it at the end of the day wrong. And part of it, I mean, I'm not blaming it to him, it was my responsibility too. But that was the toolbox we had. Now we find that there are many different hidden relationships or very key aspects about inflation expectations, expectation formations, situation in labor markets that can give you non-linearities. Therefore, we had a very nice model for normal circumstances, but as it has been said periodically here or in a reiterative fashion, turning points is what is very, very difficult. So we have entered into dynamics that are very different. So I think where there needs to be a lot of work is, and we started doing some of that job recently in the BIS, is to understand much better what is happening with inflation under the hood, why some relative prices eventually become more contagious, to use that word, and start spreading around, why some shocks are more perdurable than others, why there are some prices that generate more spillovers, what determines the frequency of firms' revision of their prices, which certainly increases with inflation. The new technology that we have talked about, I mean, now we have Amazons and we have all these markets that probably were not there, certainly were not there when CPIs were calculated a few years ago. So there is a lot of things that we need to catch up. So I think it's a challenge for us. I think as we are accumulating all this information, I'm sure also will give us, and is giving already, more leading indicators of what inflation is doing, and that will be very, very helpful to calibrate a response. So yes, I mean, I think inflation will evolve. The inflationary pressures we're facing today are very different than the ones we had in the 70s. And I'm sure that the bout of inflation we might see in some decades forward will be also very, very different. So we need to preserve that nimbleness analytically to approach, and also be very mindful that we need the right instruments. And another thing that has been very useful is that the different central banks have been able to adapt their instruments to do monetary policy according to the circumstances.
But does everybody on the panel think they understand inflation better now than they did 4 or 5 months ago? Because you could also have, again, going back to Krugman's point.
Can I say something?
Yeah.
I mean, certainly I believe that we understand it a little bit better, not fully.
No.
There is a big, I wouldn't say black box, but certainly gray box, where I think in the profession of economists we need to do better. No. And that's understanding aggregate supply. We are, at least I myself consider myself an economist that I was trained under the dominance of aggregate demand. And we know a lot how to aggregate demand responds to interest rates, how they respond to income, how monetary policy and fiscal policy has a transmission mechanism to aggregate demand. But we usually take aggregate supply as given. And it's very complex, it's very, very complex. And I think we need to understand far better aggregate supply. One confusion that is out there today, I think, is that the flexibility or the inelasticity of supply in the short term is there, but that doesn't necessarily makes it the same as a bottleneck. What is the difference? How impact that on inflation? So I think the understanding of aggregate supply that also includes labor markets is of the essence. So from the challenges we are taking forward, for me that is one that is very important.
I like the idea of a gray box.
In addition to aggregate sectorial supply, as we learned this morning with great interest, is also worthy.
Jane made the point earlier, and it's very important, that yeah, we've had a series of supply shocks. This is the thing. I mean, the word transient has become discredited, but it isn't really in one sense, because that was built on a single supply shock idea. That supply shock can work its way through. The duration of that supply shock can often be shorter than the response of transmission response of monetary policy. Now, we've not been in that world. We've been in a world where we've had a series of supply shocks. I mean, look at our shocks. Yes, we had an initial demand shock from COVID, but then we had a supply shock with the supply chain recovery problems. We've had, obviously, a very serious supply shock coming from energy and the war. And we've had a labour market shock in the UK because the labour force has reduced in size. And it's, as Jay was saying, it's how you deal with a series of supply shocks, large supply shocks, with no air gap between them, which of course feeds through into expectations, because put them all together, they're not transitory in the traditional sense of the term.
Chair Powell?
One way to say it would be, I think we now understand better how little we understand about inflation.
That's not very reassuring.
No, honestly, this was unpredicted. I was looking at our, at the time of our June meeting 1 year ago, of the 35 people who file with a survey of professional forecasters, 34 of them had inflation below 4% for last year. And of course, it was way above 4%. So really everyone had the same model, which was the Phillips curve model, and it just was not capable of producing high inflation. But what it was missing was something that's completely missing in the data for 40 years, which is basically a collapse of the supply side. Yeah. The U.S. economy is famously adaptable. It has the minimum of structural rigidities, all that kind of thing. And yet here they are. So what you had was very strong demand, but hitting effectively a vertical supply curve. So ordinarily, when people want to buy cars, which they really did because they didn't want to ride on public transportation, rates were low, they had all these savings, the car companies would make more cars, and they might raise prices too. In this case, they couldn't make as many cars. So what you got was straight up the vertical supply curve, a big price increase. But I also think, in principle at least, that process could work in reverse, so that as demand comes down, inflation could actually come down more quickly there are other relationships that people think about when they think about how do you get inflation down, which are more typical of a simply overheated economy and entrenched inflation, the sacrifice ratio and those kinds of things. But I think this could be, I don't know that it will be, but it could be different because it's just that process working in reverse potentially.
Do you see that process, President Lagarde, working in reverse? So actually, I know it's different because of the proximity to Russia.
What we're seeing at the moment is more this swing or substitution that was described earlier in the day, where, because of COVID, everybody suddenly decided to stop using any kind of services, particularly if there was social distancing about it, and move to goods. Hence the car industry in the US and, stationary bicycle rather than the fitness club. And now we are seeing this sort of substitution back to services where people who've been deprived of restaurants, hotels, transportation, theaters, and all the rest of it, that side of it is currently booming and is sustaining the recovery that is otherwise under the various series of shock that Andrew was alluding to. So how these things are going to evolve in view of the uncertainty that we have in front of us here in Europe is something that really remains to be seen.
But how difficult, President Lagarde, is it to, for example, model a gas embargo from Russia?
It has proven, look, it has proven extremely difficult. And as we have seen from the sort of misunderstanding or wrong assessment that we have seen in the last couple of years, that is difficult, for sure. And the rest is, for the moment, more in the scenario planning world than in the remodeling of what's going to happen on gas prices.
Mr. Carstens, talk to me about emerging markets a little bit. So first, it's I don't know whether they're coming to their stride because they're used to the volatility, but there are huge implications, of course, of what the dollar is doing.
Yes, of course. I think at the end of the day, a very strong dollar implies for many of them very tight global financial conditions. And so far, again, as I mentioned, the exchange rate, the impact or pressure has been contained, but at the cost of very high rates. What is a little bit concerning, not that it couldn't be managed, But for some emerging markets, this is arriving at a time where there is high corporate debt and high sovereign debt. And therefore, some fiscal prudence is important at the time where emerging markets are facing still very severe challenges. Many of them haven't made as much progress with, for example, vaccination than in other countries. Also, for many of them, the impact of the increase in commodity prices, particularly in food and in energy, is very important. I mean, usually commodities per se, foodstuffs and energy occupies a much larger proportion in their basket than in advanced economies. So that obviously reflects itself in more social need. And well, of course, many governments, according to their capacities, they are doing programs to assist people. So at the end of the day, they are on a tight situation. They have to manage things very prudently. I think if we compare this with other periods, emerging markets are better prepared. But I think that the challenges are there. I think a big challenge for many emerging markets, including I would say China, is how to get growth back at a much healthier pace. You know, I think the growth in emerging markets has slowed down. Not now, but even before the pandemic. To some extent, the virtues of globalization have sort of run out of steam, and therefore the relevance of structural reforms are very important. We need to look much better into how to get growth going independently of the use from fiscal and monetary policy. And to a large extent, that also applies to advanced economies.
Thank you. Governor Bailey, do you think inflation in the UK will be will be more elevated for longer than in other parts of the world?
Well, I mean, as Christine has said, we are going to be affected by the shock that Christine described in terms of energy prices in Europe, because essentially it's a common shock in geographical Europe. I use that term carefully, because it's a single, particularly for gas, it's a single supply system. So although we don't actually import a large amount of gas from Russia, it doesn't, in a sense, the price is formed outside that particular. So in that sense, it was similar. I think where I would, as things stand, expect some more persistence in the headline rate is because we do have, as I mentioned earlier, this price capping system in domestic energy prices. At the moment, it's a 6-month cap, but there is a proposal to take it down to 3 months. But other things equal, you would imagine that would put a bit more persistence in. And we will, of course, have to explain that, because if we can observe a downward path of underlying inflation, we will have to be very careful to explain that if that's how it emerges.
But does Brexit actually make bringing down inflation harder?
Well, Brexit, I should say, it's very hard at the moment, if not impossible, to separate out the immediate effects of Brexit and the immediate effects of COVID. So when I look at trade and when I look at labour market particularly, you can see effects taking place, but you can see that COVID and Brexit are having similar effects. And the reason I say that is because the Bank of England for some time now has had sort of a path of a Brexit effect in its projections, which said there would be a fall in trade intensity initially, and over a much longer period of time, there would be an adjustment to that. And we haven't yet seen anything to vary that assumption.
Does the fall in sterling actually help with the economy?
Well, we don't target the exchange rate, let's be clear. The exchange rate is one of many inputs to many influences on inflation, and that's the way I treat it.
So has it been a positive? I mean, we used to say that it was a positive if it was lower.
No, I don't sort of attribute positives and negatives. I'm not surprised, by the way, the path of sterling for the reason that, as I said earlier, I think the UK economy is probably weakening rather earlier and somewhat more than others. I think that's been somewhat evident now for a few months, and of course it is over the last few months it's happened. But I think in our system today, we do not attribute good and bad to movements in the exchange rate. It's one of the many things that goes into the analysis process in terms of how we think about the evolution of inflation.
I was going to ask you about the dollar and whether that helps with price stability, dollar strength.
So, like Andrew, we don't have responsibility for the level of the dollar. That's the elected government's job. That's the Treasury Department's job. And so it's just another financial condition to us. And since our economy, the external sector in our economy is so much smaller than it is for the others here, it's not that important. But dollar has been strong, which would tend to be disinflationary, but only at the very margin.
I mean, I think what we're seeing these days are adjustments in exchange rates. But I think the way of thinking of those adjustments in most economies, including in emerging market economies, are part of the adjustment process. I mean, they are endogenous variables. For example, the dollar is stronger because the US economy is stronger, because interest rates are higher, and also how the shocks that are around are affecting the different economies. So the fact that you have a very strong commodity price in Europe with gas and so on and so forth is very logical to think that the real exchange rate will depreciate. And that's part of the adjustment, So I think we're in a world where in most of the cases, exchange rates are part of the adjustment. In some cases, in particularly in emerging markets, it has more of an impact in the monetary policy management is because the pass-through for moving of the exchange rate into prices is much higher than in advanced economies. So in advanced economies, it doesn't, unless there are huge swings, the impact on the trajectory of inflation is not that relevant.
Chair Powell, Mr. Carson was talking about a gray box. What's your gray box? Is there something that you wish you knew that would help in setting monetary policy? Only one thing.
Yeah, no, I'd go back to the same thing really, which is what did we get wrong? And that really was looking at these supply side issues and believing that they would be resolved relatively quickly. And that by that I mean there were going to be vaccinations, everyone would get vaccinated, so the millions of people who dropped out of the labor force would come right back in, so wages wouldn't be under such pressure. That didn't happen for a range of reasons. It didn't happen. In addition, the bottlenecks and the shortages haven't been alleviated yet, and then on the back of that comes the new shock in the form of the war. But it wasn't something wrong with our models, because it wasn't in the models at all. It was a question of how to assess the persistence of these supply-side shocks. And I do think that there'll be, to Augustine's point, and there is a lot of work going on to get smarter about the supply side. In the nature of it, though, it was a deep in the tail kind of a risk, and those are very hard to predict and assess when they come.
Yeah. Because monetary policy is not an exact science, how often do you actually speak on the phone to exchange ideas? Do you call each other and say, like, well, I've done it this way?
I can help out. I mean, because part of my job is to be able to attract them to Basel 2 times every 2 months to have very, very deep and open exchange of views.
We do talk, but we're not going to tell you.
And you all show up.
Yeah, you'll show up. We speak quite often.
Quite a lot, but you're not going to tell me. President Lagarde, the ECB decided to apply flexibility to reinvestments from Friday, July the 1st. What will be the guideposts?
We decided. Look, I think if you allow, I'd like to just come back to why that is. Yeah. Because I think that this risk of fragmentation that is much talked about is something that is very inherent to the European construction. Yeah. And to the fact that we have 19, soon 20, but let's say 19 for the moment, member states that each have their respective fiscal policy, that each have their respective financial markets. And as a result of that, our unique monetary policy has to be transmitted throughout this imperfect market of ours, which has no fiscal union, no monetary union, no capital markets union. And as a result of that, we just have to make sure that our monetary policy stance is actually transmitted throughout the entire euro area. And the two of them, I think I used that word, I don't know if it exists in English, but they are consubstantial. For our stance to be effective, it has to be transmitted throughout, okay? So to do that, if we see that there are unwarranted disruption to that transmission, and if our stance is impaired as a result, we need to take action. And that is the reason we decided that we would use, as of, you're right, Friday, that's what I said yesterday, we would use the flexibility in the reinvestment of our pandemic emergency purchase program redemptions in order to address the potential risk of fragmentation. Second, we also decided, and it's work in progress, so I'm not going to comment upon it. I know that some would like to have details and understand before everybody else, and particularly before the Governing Council, what the details of that instrument will be, but we decided to reinforce our capacity to properly transmit our monetary policy by devising a new tool that will be considered by the Governing Council of the ECB on July the 21st. So don't waste your time asking me for details, criteria, conditions, safeguards. All I said is that it has to be effective, it has to be proportional, it has to include the right level of safeguards. And that's all I will say at this point.
Okay. How do you direct staff?
And it will be effective, and it will be proportional, and it will have safeguards, and it will be there, believe me.
So how do you direct staff? I'm going to try my luck one more time. How do you direct staff when they design this new tool?
I said what I had to say.
The lady is not for turning, is the famous way. How do you look at China, Mr. Carstens? How should we look at China at the moment?
Well, I mean, it is of the essence that things start improving more quickly in China. I mean, certainly we need the growth that has come from China. Mm-hmm. They play a very important role in the supply chains. I mean, many of the tensions we're seeing around the world could be mitigated by having higher growth rates around the world. I mean, part of the way we have started this conversation was trying to assess, or you wanting to hear our thoughts about how can we bring down inflation without affecting growth. If we have other sources of growth, that would make the whole adjustment process simpler. Now, what is one major engine of growth that has not been contributing as much as it could? I have to say China. No, they have problems that are well known. One that I hope that can be resolved soon is the one in the housing market. I mean, the housing market has been, or that sector, it's a very important contributor to growth. A lot of, certainly very much impact in the rest of the global economy, and it's a sector where the Chinese authorities have been working a lot, trying to bring it back to its foot, and hopefully they're close. But I mean, I would say at this stage, for their own sake, they're not growing as much as they certainly would like, and certainly they're not growing at the pace I would like them to see growth, because I think it would help us a lot in trying to solve some of the tensions we're living today.
Do you think we'll see, Chair Powell, more deglobalization, and how that will impact our economies going forward?
So there's certainly a threat of that, and this is not the work of the central banks, but I do think it would be a plus if we were to find a way to, for China to take part diplomatically and economically according to a common set of rules, and that would be a big plus for global growth if we could get back on a path to that. But it's obviously that's the work of elected governments, not for us. In terms of globalization, Yes, I mean, you can imagine a world. It's not hard to imagine a world where we break into these blocks again, and that would be a world of lower productivity and lower incomes over time. It doesn't have to happen that way. People are looking at shorter and more durable supply chains. It's not clear how much of that will happen, and if so, what would be the effects? That could be more secure, but perhaps not as efficient as the long but fragile supply chains that we've had. So I think it's a very important question, and there's certainly a risk that the benefits of globalization would be lost, but obviously there were benefits and there were costs to the advanced economy, certainly.
I mean, a question for all of you, and Paulo, I'll start with you. What have we learned about the last 10 years of monetary policy, some of the tools that were used, be it QE or in other parts of the world, even negative rates?
So the last 10 years were so far the height of the disinflationary forces that we faced. And really, it goes back before the global financial crisis, but really since the global financial crisis, we had very low inflation. In the United States, we had 3.5% unemployment for a couple of years, or right in that range for a couple of years, and inflation didn't react at all. So we had that gave us the ability to really lean into the maximum employment mandate, and we did that. And I think that was the right thing to do in that world. That world seems to be gone now, at least for the time being. And we're living with, as I mentioned at the beginning, we're living with different forces now, and have to think about monetary policy in a very different way. So I think if you want to know the lessons to be learned of the last 10 years, look at our framework. Those were all based on a low inflation, environment that we had, and now we're in this new world where it's quite different, with higher inflation and many supply shocks and strong inflationary forces around the world. It's quite a different environment.
President Lagarde, how do you think we'll look at negative rates, first of all?
Well, I look at it in a similar way to Jay, and I think the last 10 years have been 10 years of heroic fight against disinflationary forces, with central banks demonstrating great agility to innovate and find sometimes alternative, accommodative ways of dealing with forces that have nothing to do with what we are experiencing now. So we're certainly learning from that period, but we are in a new environment, which also, I think, will force us to show agility and capacity to respond fast to data that we are receiving at an accelerated pace, and with a scene that is changing geopolitically as well as economically.
Mr. Carstens, do you think...
But I don't want to sound too dark, because I think that there are also good things happening. I was reflecting on your comments, Jay, and think back, December 20, when we thought that this pandemic was going to hit us for the next 2 years, at least, until such time when vaccination would come to market. And vaccination came about in a matter of 9 months, as opposed to the 3 years that it normally takes. In the same way, everybody expected a couple of weeks ago that the Geneva Agreement of WTO would be a complete illusion, would never happen. Well, certain things happen when there is goodwill, agility, creativity. So I have great faith in human inventivity and talent, particularly when it includes women.
To your point, though, a lot of these problems are happening because the recovery and the expansion have been so much stronger and faster than expected. If you look in the U.S. labor market as an example now, it's a very good time to be in the labor market. There are 2 job openings effectively for every unemployed person. So people are switching jobs, they're getting pay increases. It's a terrific labor market. The problem is that wages are moving up in some areas at levels that are not consistent over time with 2% inflation. So it's kind of overheated. Nonetheless, it's a byproduct of a very strong recovery.
Governor Bay, on pay increases, I mean, the UK is going through a bit of a bumpy ride with a lot of pay increases. How do you see that developing?
Well, of course, it's a reflection of the inflation world we're in at the moment. I mean, I'm on record as having said a few months ago that, and I'll be careful because I'll get it right and precise in terms of what I said, that I think very high pay increases, and particularly and this applies to both pay increases and price setting by companies. If everybody tries to beat the inflation, and particularly the version we're having, which is this imported inflation shock, which we just we can't avoid, then it will set the second round effects off. And of course, yes, we are seeing some of that tension unfold. I would have to note that rather more people seem to be agreeing with me today than were doing several months ago. But that's not the point. I mean, the point is, yes, I think it was likely that we would see this, but I think I have to say the point about second round effects holds as much today as it did then. I mean, that's the risk. And that's why we will set monetary policy, obviously, to offset those if they emerge to get back to target. We will have to do that. And that's, I'm afraid, a thin code for saying the more they emerge, the higher rates will have to be.
But what sort of pay rises could be alarming for the Bank of England? Is anything above 2% inflationary?
Well, I don't think that's the right way to look at it, because obviously there's always a productivity angle to it in terms of how pay is set. And it's very important that, I made a general comment about second round effects, but of course pay is set in a market, and that's important, and it must continue to be set in a market. So it's wrong to say across the economy this is the right number, because it isn't. Different cases and different situations. But I would just emphasize this point about second round effects, which is the crucial point for monetary policy.
Mr. Carstens, has there been an over-reliance actually on monetary policy in the last 10 years?
Well, I mean, I think even going a little bit further away, 2007, 2008, monetary policy needed to respond, to put it in a different way, lack of resilience in growth. And yes, to some extent, policies that traditionally are meant to support some fluctuations in the business cycle have probably been used a little bit more with probably in a more lasting way. And my sense is the role of fiscal and monetary policy to stabilize the business cycle into the future are hitting limits. In fiscal policy is obvious because there are issues of debt sustainability, or can be issues of debt sustainability. And well, now if we had a long period where monetary policy could have an impact on growth, because as Christine said, as Jay Powell and Andrew have said, we faced a very, I would say, specific period of time of very low inflation, and where monetary policy could make, if you had the instrument, why not use it, no? But I think what we should learn, and this is not only, I mean, at the end of the day, the economies do not depend only on monetary policy. At the end of the day, they depend on fiscal, monetary, but also many other real policies that are out there. And what we have seen is in the last 10, 20 years, it's a very unreliable process of economic growth in the world. Some, of course, have been distorted by issues like wars or pandemics, but even before, I mean, we don't have the resiliency in growth that we would like to see. And that puts at different points in time a lot of stress on fiscal and monetary policy. And at some point that has some impact. So I think, yes, monetary policy will have to adjust, will have to evolve. We are learning lessons. But I think where we need to work more is to understand growth and how can we promote it in a more reliable fashion.
Who doesn't agree with that on the panel? Does everybody?
It depends what kind of growth. And I really think that the determination of the Europeans to focus and encourage investment in the green growth is critically important. If we want to develop the economic potential of any economy, you have to go in that direction.
That's the part of reliability.
Yeah. And resilience.
Yeah.
If you don't. Yeah.
Governor Bailey and then Chair Powell.
Well, I was going to observe, I mean, a point I was going to comment on following what Jay and Christine were saying earlier about what we've learned from the last 10 years, and then make a point on growth. I mean, one of the things we learned over that period was that the underlying interest rate, the sort of structural R-star, seems to have gone down for a long period of time, actually, certainly in the UK when we look at it. The question is, what do we learn? You know, these structural issues that we're facing today, what do they imply for it? I'm probably not in the same place as Charles Goodhart, because I think these trends are so long run, particularly on the sort of population side, on longevity side, that they have quite a long way to play out, even on the basis of what we know today. So I think the underlying story will obviously move, but there's a lot that's sort of built into it already. Just on the shorter run point on growth, I mean, I think one of the puzzles which we're certainly looking at on that, though, if you take that sort of underlying story of the last decade, certainly in the UK economy, is why hasn't investment been greater? Because there's a gap opened up between the sort of the risk-free rate and the return earned in the risk-taking environment, and yet investment has been very subdued. Now, I think the other question we have to ask there, but are we capturing investment there? I mean, that's something we're looking at certainly, which is there just more investment of a non-traditional sort, which probably not wholly, but in part helps to explain that. But I think, I see that as an important issue to understand in terms of what we want to know going forwards, because there's no question that investment is, Christine was saying in terms of climate change, is a big part of the picture going forward, and how we solve some of these issues that we've been living with in terms of low investment and low productivity in our case as well.
Chair Powell, do you think we've been over-reliant, actually, on monetary policy, especially as the Fed?
Yes, I do. I would just say, I think that in economic discussion generally, there's much too much focus on demand management and not enough on things that will make us grow at the maximum sustainable level, sustainable growth in the longer run. There's not enough focus on that. And that isn't the Fed's job. That's more the job of, again, elected governments. But I'd like to see more of that.
So how should governments be thinking about their economic policy going forward if monetary policy is not the only game in town?
You're asking me that?
Yeah.
So I'm kind of out of the business of giving advice to the fiscal authorities these days. So I would just say, I think when I get asked that by an elected representative, what I say is focus on investing in people and investing in things that will increase the productive capacity of the economy over time. That's what I say. And in terms of, I think what a central bank should do is stick to its knitting and do its job, and leave the major issues of the day to the elected representatives.
President Lagarde?
We have to stick to our knitting, that's for sure. But if we are asked for advice, we should give it. And I think that, to the extent that fiscal and monetaries have worked hand in hand during the pandemic and to good effect, I think we should also reflect on how fiscal can leverage what we do and how we can facilitate it. But we're not, this is no longer the same cooperation, hand-in-hand work that we used to do during the pandemic. And I would give the same advice. Invest in people, invest in green, be targeted and focused. And in the medium term, the fiscal space has to be made sustainable for all countries, certainly in the euro area.
Yeah, Mr. Carstens, what's the correct way of fiscal policy to help monetary?
Well, I would definitely add my voice to invest in people, but I would say more in different aspects that enhance the human capabilities. Very specific. Well, education is one. I think what we have learned with the pandemic is that health systems are extremely important, and I think to a large extent we have invested there. The other thing is that all digitation will imply, and technological advance will really impose very, very dramatic pressures in many countries. And I think to how to adapt ourselves to that is very important. Climate change, as Christine said, is of the essence. In many parts of the world, incorporating ladies, females into the labor force is very important, and investing more in them, I think it's also of the essence. In many parts of the world, law and order is very important. Yeah. And so I mean, the good and bad things is that there is a lot to be done, but there is a wide variety of areas where we can act, and I think it can have make a difference relatively soon.
Governor Bailey?
Well, I mean, Jay's right. Independence goes both ways in our world, and we must respect that, and we do. I think there's a common interest, going back to what I was saying a few minutes ago, in understanding why the trend rate of growth has fallen, because it has, in our case, it has fallen. Now, I don't then, for a central bank, I'm not going to start prescribing what should be done about it, because I think in most cases that will be outside our remit. But obviously, we have a strong interest in the trend rate of growth. So understanding the trend rate of growth is an important thing, and it's something where we can collaborate in that sense, I think, perfectly happily.
It's 3:27, so we only have 3 minutes. And I mean, I'd like to ask you, just to close us off, Chair Powell, if you're speaking now to the American people to try and help them understand how long it will take for monetary policy to go back to something that resembles normalcy, what would you tell them?
I would say that we fully understand and appreciate how the pain people are going through dealing with higher inflation, that we have the tools to address that and the resolve to use them, and that we are committed to and will succeed in getting inflation down to 2%. The process is highly likely to involve some pain, but the worst pain would be from failing to address this high inflation and allowing it to become persistent.
President Lagarde?
Ditto.
Governor Bailey?
Oh, absolutely. I would just add one thing that is to Jay's point and Christine's point about understanding the pain. This form of inflation is even more painful for those on low incomes because it is concentrated in the essentials, in energy and food. And when you look at the consumption baskets of different groups of income groups of the population, sadly, it's those in the lowest income who are most concentrated in those things. And that is very difficult and something that obviously is very sad. But we have to do everything we can, because as Jay said, if we don't get it back to target, the consequences are worse.
Yeah. All right, it's 3:30 p.m. So thank you so much for joining us, and thank you so much for a great panel. I'm going to ask the gentleman to follow me, and Madame Lagarde, you stay on stage. Okay.
Thank you, Francine, for doing such an excellent job of moderating that session. And thanks to all of our panelists. We've seen a turning point, and now we've heard about how central bankers are grappling to avoid a tipping point where high inflation becomes entrenched. The clock is clearly ticking, but for now, faith holds. And now to the final part of our event. The Sintra Forum has brought together some of this generation's most prominent policymakers and academics. It has also sought to nurture young talent to address the answers to challenges future generations will face. We now would like to award the prize, chosen by an expert panel, and you, for the best paper by some of the most promising young economists in the world.
So, we've just seen the 10 finalists of this year's Young Economist Prize. Actually, they're all there. This time we can see them in real life because they're not on screen as they were last year and the year before. So it's very, very nice to see you all, and you're very welcome in this room. Yeah, let's. So you came from all over the world to present your research here in Sintra, And our colleagues from the research department were overwhelmed by the number of high-quality papers that they received. You are the top 10, but there were many others that were submitted that were of top quality as well. So all submissions were rated for both their academic quality and their policy relevance for Europe, and 10 of them, you, were selected to go through the final round of voting. It is an important moment for the forum, so I would like to thank you very, very much, all of you who have voted for the respective papers and for having spent a bit of time in front of their posters when they explained to you what their research was about. I would like to express real gratitude to all members of the panel who have evaluated your papers. They are Hélène Ray, professor at the London Business School, Ricardo Reis, professor of the London School of Economics, and my ECB colleagues Philippe Hartmann, Isabelle van Steenkist, and Yvan Jacquard. Thank you so much for having spent this time and having taken such an interest in the work that they did. Well done. So don't be shy. I know it's a moving moment, but you have to come on stage now. So it's really, really good to see you in person, and you have in front of you, the best and the brightest in central banking, in academia, in macroeconomics, and they are intimidated because you will be much better than they are at the moment. So I know it's not a very pleasant moment for 9 of you, and it's a delightful moment for 1 of you, but I'm going to have to do it. But I took some consolation from the fact that I was told by a friend of mine and a couple of other colleagues that just the fact that you were shortlisted and amongst the 10th actually gave you a chance to receive a few phone calls from people interested in hiring you. So in and of itself, that might be a bit of a prize. But for this particular contest, I'm delighted to announce the winner of this year's Young Economist Prize, who will be awarded a 10,000 euros prize and this trophy, which is standing right there to my left. And the winner this year is Federico Cochen. Federico. So Federico, before I award you this, I just want to mention that you are a PhD student at the New York University. Your paper was on finance over the life cycle of firms. I have to say that Federico explained to me his research, and he gave me a great consolation this morning. You know what you feel like after some long hours and days. He explained to me that the older you are in the cycle, the more resilient you are. Fantastic message early in the morning. So thank you, Federico, in addition to everything else in your paper, which is far more important than the consolation that you gave me this morning. But so your paper highlights the importance of ensuring that young firms, which are more likely to face financial constraints, have access to external finance. Using European data and emphasizing the differences between countries, your paper shows that in times of great structural transformation, ensuring a steady flow of financing renders the process of firm entry and exit more efficient. So my warmest congratulations to you. Here is the trophy. Well done.
Thank you very much.
I will hold it for you.
Thank you. Thank you very much, President Lagarde. This is really an honor and such a privilege for me. I also want to thank the members of the selection committee and all the members of the ECB which made this prize and this event possible. As well, I want to thank my fellow young economists. This has been really a privilege for me to be interacting and learning from you these days. Thank you very much. It's really such an honor. Thank you, President Lagarde.
Thank you. And can we give a big round of applause to the other 9 who have done a superb job? Terrific. You can just stay a little bit. It's nice to be up on stage. You have to get used to it. You'll do a lot of those things. So now it's the last moment. We all want to sort of let our hair down, enjoy a bit of outdoor activity maybe, or just rest, or keep looking at your emails and your messages, whichever you prefer. But it's time to wrap up, and I would like to really thank all of you for your participation, being in the audience, being so attentive. And I would like to address a particular thanks to the team of the ECB and those who have put in place this first, after 2 years, physical organization of this meeting. They've done a great job. The food was decent, wasn't it? And everything else in between. So to those who have organized it, really, thank you very, very much. And you'll be pleased to know that we've decided that next year, again, it will be in physical format. And we'll see after that how we measure the cost benefit and the value added by being together relative to increasing, obviously, our environmental footprint. But we'll certainly this year, yeah, Vitor, we have to do these things nowadays. We do. But next year we'll be together for the 10th. In the meantime, obviously, there is going to be a lot of work that will be done, a lot of research. We are obviously in a slightly different environment as the chair and president of central banks have tried to demonstrate, and as has been fantastically documented and discussed in the course of the very great panel discussions that we had in the last couple of days. To all panelists, to all those who contributed their papers and their thought and shared their brain power with all of us, and those who led the panel exercise, which is not always easy because it's tempting to actually get involved and speak up and say what you have on your mind, when in fact you have to just give way to those who have done the work. Thank you so much. We have a wonderful dinner that is offered by the National Central Bank of Portugal. We will see each other again, and we will see each other next year if you are so willing. Thank you very much.